It's 9 a.m. here in New York City. I'm Madison Mills alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco.
Good morning, everyone. Let's get things started with the three things that you need to know to start your trading day. Stock futures, they are in the red this morning to kick off the first trading day of September. Now, Wall Street is bracing for what's historically the worst month of the year for stocks. A slew of economic reports will headline this week, and today we'll get manufacturing numbers. Yes, that's going to kick things off. And later on the docket this week, we've got a fresh read on job openings, all concluding with the big August jobs reports due out Friday. Now, that report could determine the size of rate cuts to come from the Federal Reserve this month.
And earnings season, it's not quite over yet. We've also got Broadcom, the latest chip maker to test the AI rally. The company is the number 2 U.S. chip maker by market value, trailing behind Nvidia. And this comes as the chip sector has been under a bit of pressure following Nvidia's earnings, which, as a reminder, they did top estimates but indicated slowing growth to come for the chip giant.
And finally, we are on Musk watch. Brazil's Supreme Court upheld its decision to ban Elon Musk's X nationwide on Monday. Now, the unanimous ruling, it comes a week after the court ordered the social media company to be suspended over misinformation concerns and for failing to appoint a legal representative in the country. Now, Musk is fighting back, calling the country's top judge a, quote, dictator who should be impeached. Well, stock futures are in the red to start September, and historically, the odds are not in investors' favor for the month ahead. September is traditionally the worst month for global stocks, and 2024 could prove uniquely challenging as the market prepares for the Federal Reserve's first interest rate cut in, get this, 4 years. Now, a few of the stats here that I've been tracking, at least coming out from BofA Global Research here. September has the weakest seasonality of all 12 months of the year, with the S&P 500 up only 44% of the time since they've been tracking this, and on average, seeing returns of, get this, negative 1.2%, Maddie.
Yeah, it's interesting because that's what investors should be watching in terms of why September is in the degree of downside pressure we see in stocks for September. But why is that the case, right? Why is it that September is such a weak month for stocks? Well, one of them, I feel like our audience is going to love this one. It's the end of vacation season, right? People are coming back from those Labor Day trips, investors getting back to the office, and then all that bad news from the summer really starts to digest in their stomachs over the course of the month of September. And that's why you see a little bit of downward pressure. Now, you've also got some of that lull in between earnings cycles. That can be an issue, particularly as you are in between reporting results season for companies. But this year, we do have some other catalysts. We've got the Fed meeting, and we've also got the election. And I know you're going to talk about that, Brad. But also, it's tax loss harvesting season for some of these mutual funds. So that's another reason why we see some of that pressure in the month of September.
Yeah, and I'll get to that election stat in a hot second. But just before that, one of the other things, too, is the weakness that we're seeing here in September. Typically, at least historical basis here, one of the key tactical levels to keep a tab on, and if we can toss up a chart of the S&P 500, we're nowhere near that marker right now. But if we did see weakness to the extent that we have before in September, S&P 500 5560 is the key support, tactical support level that Bank of America is pointing out. All right, so that's the bad news, but here's the good news. We could be seeing a setup for a year-end rally, and here's why. In an election year, and there you're taking a look at that longer-term chart here, just the last stat that I've got, presidential election years actually show lackluster average, not just for September, but also for October. Markets don't like uncertainty. The election, of course, gives you an event where that uncertainty certainly does run rampant here. And typically you see September returns of negative 0.5% roughly, and then negative 0.3% in October. But good news, and we'll end with this. This tends to precede a post-election rally into year end. So that is something perhaps a bright spot on the other side.
All right, well, perhaps a bright spot as investors are anticipating a slew of economic data this week. Top of mind, though, that August jobs report due out on Friday. That could be a key determining factor for how deeply the Fed could cut interest rates at its meeting this month. And this comes amid that worst month of the year for stocks. So here to weigh in on how investors can prepare, we've got Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Victoria, it's great to have you on here. So talk to me about how you are thinking about the month of September in the context of a month where we've got the Fed meeting and we are, as of today, 9 weeks away from the election. Is this September going to be different than those other bad ones we've seen before, or more of the same?
We always like to say it's different this time, don't we? But I'm not so sure that it actually is. I think we will see continued volatility during the month of September for many of the reasons that y'all have been talking about. We have the election coming up. We have a Fed meeting that's coming up. We just finished earnings season. There's anticipation as to what earnings are going to look like going forward. We have a consumer that's pulling back. So there's a lot of different elements at play here that I think could cause the volatility to continue.
And so if there was continued volatility, and great to have you here in studio with us, Victoria, if there was continued volatility, where are some of the areas within that kind of dip buying mentality that's really starting to push investor sentiment as of right now? Where are those areas that you would be apt to hop into?
Well, I think you want to look at areas that typically do well in uncertain times, right? So you're looking at things like staples, you're looking at things like healthcare. These sectors have actually done pretty well as of late. They're sectors we've been adding to this whole year, but trimming those tech names in order to have the cash available to do that. Hopefully people have been trimming from the beginning of the year, taking some gains off the table. We've seen some of the breadth in the market that a lot of people were happy about, but it was coming in the small caps. I would be a little cautious here. The market does not like uncertainty, as you said a moment ago. Small caps really don't like uncertainty, and I'm not sure that 25 basis points is going to turn around the story for small caps, and we think we only get 2 cuts this year, not the 4 that are priced in. So I would be a little hesitant on small caps. Look in some of those more defensive areas.
What would it take for us to get a 50 basis point cut at that February meeting? How bad does the news have to be on Friday for us to get that?
Yeah, it's a high hurdle that you have to have, and it would have to be some pretty negative news to come in. I don't think anyone's really expecting to have the jobs numbers come in that poorly. If they do, then the Fed still has a little bit of time. And don't forget, we have CPI next week as well. Sure. So if we had a large jump in CPI, again, I don't think we're expecting big surprise moves. But if so, then the Fed, I think, might consider a 50 basis point cut. But I still don't think that's going to be their base case. I think they want to stick to 25, start slow, because all along, what has the Fed been saying? They don't want to move too quickly because they don't want to stoke the fires of inflation that could still be there. There are some sticky components. You don't want to get that demand going so quickly that those numbers start to move higher.
Well, that would spell out that you also have to have a consumer that's continuing to push back on price, which is bringing inflation down even further from this point to get closer to the Fed's target. What are some of the most consumer-sensitive areas of the market right now that investors should be paying close attention to as they are trying to navigate what is a consumer that is what we've heard as battle-weary or battle-tested, or trading into places like Walmart, as John David Rainey, the CFO over there, told us?
Yeah, so retail is actually an excellent area, right, to look and see what the consumer is doing. Walmart is a perfect story on that. The thing I think people need to realize is you look at Walmart's numbers. Is Walmart doing better because the consumer is out there spending more and excited to spend more? Or is Walmart doing better because their base grew because they had to bring in normally higher income earners that shop other places are now coming into Walmart? Walmart's numbers are better because they're 30% grocery, and the largest benefactor of food stamps usage actually turned up. It's been down for almost a year and a half. It's now turning higher. So is Walmart doing better because the consumer is not doing better and they are all flocking there? I think that's part of the story. You kind of see the dichotomy between lower and middle income consumers and higher income consumers in retail earnings. So I think that's a good place to look. And watch the wage numbers, watch the savings number. Savings has dropped to a 16-year low last month. That's telling us that even though consumers continue to spend, it's not from higher wages. They're pulling out of savings, and we have to be concerned about that.
So are we still on track for that soft landing, or are there some things in there that are looking a little tough?
I have always been a little doubtful of the soft landing. So, maybe I'm the Debbie Downer of the party that's here, which I don't want to be. But you look at some of the elements we talked about, small caps, only 40% of those companies over the last 12 months have actually made a profit. We look at the labor force and we say, wait, there's more people that are going for part-time work. We have a higher percentage holding 2 jobs for economic reasons. The hiring rate is lower. I know everyone's waiting for Friday for the jobs report. I actually think the JOLTS report is the more important report coming out tomorrow. It tells us hiring. It tells us that labor differential, which is actually at a 3-year low. That's a proxy for unemployment, and it looks like unemployment could be moving higher. So I think there's a lot of uncertainties that we get a soft landing. I'm not saying we go full-on recession, but I think we could be, waiting for a larger pullback. Perhaps that's what we do, Brad, go in and buy the dips a little bit. Maybe not a 1 or 2% move. We've been seeing quite a bit of volatility around those levels, but could see a larger pullback.
In past cutting cycles, we've seen tech be one of the beneficiaries. Are you expecting something similar this time around? I mean, especially considering the run-up that we've seen, really driven by so much kind of excitement and exuberance, over-exuberance, if some have called it, for the AI trade right now.
Yes, so tech has had such a strong run. I mean, in our opinion, what we're doing is we're actually trimming those names, as I mentioned a moment ago, and using that for an opportunity to go into other areas. So is tech going to be the leader going forward? I mean, look, AI has a long runway to it. And so I think there will be a lot of beneficiaries of AI over the course of the next few years. Do I think they're going to lead at the end of this year? I think you're going to see a little bit more broadening out in some of those other sectors. We talked about financials being one of our favorite, especially as you see some disinversion of the yield curve and seeing yields maybe move a little bit higher, but continuing a longer trend probably down from here.
Victoria, it's great to see you here. Thanks for making the trip all the way up from Texas.
Thanks,
Lone
guys.
Star
It's
State.
my pleasure.
We got a little, we got some cool seasonality that's really rolling through right now, early September. So hopefully you appreciate the breeze that we
Feels
got
good out there.
We dialed it up just for you. Victoria Fernandez, Chief Market Strategist over at Crossmark Global Investments. Thanks so much. Well, coming up, shares of Boeing. Right now, we're tracking them on the move pre-markets to the downside by about 4% after Wells Fargo downgraded the stock to underweight from equal weight. We'll have those top movers for you on the other side of the break. Let's get to some trending tickers that we're watching for you this Tuesday morning. Shares of Boeing falling after Wells Fargo downgraded the stock to underweight from equal weight. Now, the analyst Matthew Akers also cut his price target by $66 to $119 here, suggesting the stock could drop over 30% in the next year. There you're taking a look at shares of BA. They're moving lower by nearly 4% after this downgrade. And one of the huge things that was pointed out, they expect cash flow to peak around 2027 at or below Boeing's target of $10 billion, and they're pointing back to some high costs associated with aircraft development as well here. They're also seeing limited upside. Even if Boeing delays new jet development, adding in long term, this would mean ceding significant share to Airbus's new plane as well here, in this kind of large plane order or large plane manufacturing duopoly that the industry essentially has right now.
Yeah, it's a great point, too, that you brought up earlier, Brad, just in terms of not only the impact this has on a company like Boeing, but also some of the other airlines in the space, which we'll get to later on in an interview we're going to have on the program. But with Boeing, the issues just continue and continue here, and that might be why we're seeing a street low when it comes to a price target on Boeing here. Also, some additional news I want to get to this morning on Boeing. Contract talks with one of Boeing's most important unions may not be able to avert a strike that could derail the company's recovery even further. So this is not only a company that continues to be in headlines because of issues with its manufacturing and its product, but also now issues with its labor force. That is only going to continue to put some pressure on this stock moving forward, as we can see through analyst ratings like this one from Wells Fargo. All right, we're going to stick with airlines here because Elliott Management officially holding 10% of Southwest Airlines common stock. You can see that stock up a little over 2.5% in the pre-market here. But why does it matter? Well, crossing that threshold of 10%, that allows the hedge fund to call a special meeting with the airline. That is according to Reuters. The two are currently scheduled to meet coming up here on September 9th. So this is really interesting because Elliott is going to have that meeting coming up on September 9th here, and they are able to have that special meeting. Again, that reporting according to Reuters here. But the hedge fund had taken an 11% economic stake through derivatives and converted most of those holdings through to common shares. That's how they were able to acquire this degree of stake in Southwest. But not the only news for Southwest this morning. We also have Evercore upgrading the stock, so that's another reason you might be seeing some positive movement here. Evercore upgrading the company to outperform from in line due to long-awaited transitions to capacity discipline. Interestingly, that they're kind of cutting back on some of the flight paths that may not be as profitable for the company. So certainly a lot of news when it comes to love shares this morning.
Yeah, I mean, a lot to not love. If you're a shareholder over the past 5 years looking at this stock, it's been down by about 44%. You think about what Elliott is looking to put forward here and why this all matters, as you were putting into perfect context a moment ago here, especially as they had been accumulating stock and really becoming more interested in taking a more outsized position in Southwest. It started to become evident back in June of this year. And of course, now you think about what type of executive changeover we could see if Elliott is successful with its own activist campaign within Southwest. Should it be furthered and should it be doubled down on here? Of course, thinking back to the ousting that they're kind of pushing for here, $70 billion in assets under management that Elliott has here, but they're looking for Robert Johnson and Gary Kelly to get the boot here from this company. And so if they are successful, you could be looking at a different executive leadership team. What does that leadership team do to try and make sure that they're prioritizing not just shareholder returns, but profitability and long-term profitability for the company, especially considering the fact that they've been operating in this kind of ultra low cost nickel and diming for years. And now how can they kind of, a consumer environment where people are pushing back on price and for airfare prices where they're trying to seek out deals. We heard that through Airbnb's earnings a few weeks ago, that the lead times for people booking are actually shrinking. What does that mean? They're sitting on the sidelines and waiting to book some of these travel and accommodations. And so for Southwest, that's not good news because ultimately you would rely on some of those people booking earlier in advance, adding on, showing a little bit more strength in those consumer dollars. That's not the equation right now, or at least not the environment that they're operating through. That's a headwind. And then you've got the headwind add-on of Elliott that could be looking to throw some weight around at the board level too here. Yeah, so we'll see.
Absolutely.
Also, let's talk a different element of mobility, Tesla. Tesla saw its best sales in China of the year during the month of August. The company is selling more than 63,000 cars. That's up 37% from July, but still down from last year. Shares right now, they're reacting positively. It's up by about 0.8%, so not like hoorah-rah, but it's like a meh, okay, good news.
Okay, good news for Tesla here. It's interesting, Brad, because on its face, this does seem like it would be positive news, again, where you're talking about Tesla's China shipments here. But I want to pull up a stat that can give a little bit of context here. Automakers wholesaled a little over 1 million electric and hybrid vehicles last month. That's a 32% increase from a year ago in China. So it's just indicative of the fact that we are in a little bit of a cyclical recovery when it comes to these sales. Again, Tesla here shipping over 86,000 Model 3 sedans and Model Y sport utility vehicles in August. That's up about 3% from a year ago. So certainly an increase when it comes to Tesla and a recovery from the challenges that they had in the region in the first half of this year. But when you zoom out and see kind of the upside movement in the broader EV space, particularly in China, Tesla does not look as rosy as that headline number may indicate at first blush here, Brad.
Yeah, you're talking about the competition here. BYD, they sold a record 373,000 new electric vehicles in August. That's up about 36% year over year. And then you think about another company that we were talking about just last week with XPeng, they were also seeing their sales up 26% now, not nearly at the same level, at least on quantity basis as a Tesla. It's only about 14,000 vehicles for XPeng. But Li Auto, that one was a little bit of slippage here. So perhaps that's where we're watching a little bit more of kind of the market share tug of war taking place, especially with the consumer looking across some of the optionality for some of the homegrown, home-built out electric vehicle options in that market and in the greater China region as well. Let's stick with Musk for a hot second. There's always a multitude of headlines swirling around him. Brazil's Supreme Court has upheld a ban on Elon Musk's X over the weekend. The social media app, formerly known as Twitter, has been banned in the country since Saturday. With more, let's bring in Yahoo Finance's Alexis Keenan. She's been tracking this one. Alexis, what do we know so far?
Hey, Red. Yeah, never a dull moment with Elon Musk, right, in the legal world. So X had been blocked in Brazil after SpaceX-owned broadband provider Starlink refused to obey an order from Brazil's highest court. It's a panel of judges that said that they affirmed this very controversial decision that X should be blocked, saying all ISPs must block the social media company nationwide. And that ban was based on a claim that X had allowed false statements and posts about Brazil's voting system and also had allowed hate posts. Now, Brazil's telecom provider, or regulator, I should say, has also threatened sanctions against Starlink last week, freezing reportedly, according to multiple reports, frozen assets of Starlink. Now, in response, Musk has said in a number of posts over the weekend that this activity by Brazil's high court is illegal. He says his companies are being asked to basically break the law by silencing political speech. He said on X, unless the Brazilian government returns the illegally seized property of X and SpaceX, we will seek reciprocal seizure of government assets too. Now, he did not provide any details about how that would be accomplished. Starlink provides 20 million users with internet connectivity. So these are a lot of customers, unless they use a VPN, will not be able to access the social media company. Starlink has not responded to Yahoo Finance request for comment on this matter. But guys, the company in X has been banned in a number of countries. This is not certainly the first. You have China back in 2009, Turkey in 2009, Iran, North Korea, Russia, Venezuela, just in August of 2024, Pakistan, Myanmar. So this is coming on the heels of those bans. But as for Musk's response and Starlink's response so far, they're saying that this does not comport with the laws of Brazil. So in this case, Musk, X, Starlink fighting back, guys.
So, Alexis, I just want to stick on this for a second because I'm curious, as this starts to, like you just pointed out so well, this starts to become a little bit more of a trend. We're seeing this in several countries, the blocking of X here. To what extent does that cause any type of reform at X in terms of how they handle any type of false information that's posted on the account, even by Elon Musk himself, by the way, posting some misinformation regarding Vice President Kamala Harris as recently as this weekend?
Right. And he did criticize and post some former interviews of Kamala Harris talking about the fact that there should be more structure around what can and can't be posted to social media. Trend or not, Musk has, of course, held himself out for a long time as a defender of free speech, First Amendment in the case of the US. So he definitely wants to make sure that this is a platform where people can express ideas of all kinds. He has said that repeatedly ever since he expressed interest in buying the platform. Another kind of wrinkle here is Tesla. Not too much of an issue at this point in terms of repercussions maybe for the EV company. Tesla does sell autos, but they're in Brazil, but does not have operations there. However, when you look at 23 to 2024, EV sales did almost basically double in the country. So certainly he would want to, I think, be part of that. No repercussions at this point, as we know of, for Tesla. But whether it's a trend or not, it's just such a controversial issue of how much of that gray area or purported false statements should be regulated. So more to come here, I'm sure. But at this point, Musk is digging in his heels.
All right, Alexis Keenan, thanks so much for breaking it down for us. As always, we appreciate it. Now, coming up September, it's not just a tough month for stocks. We're going to break down why Bitcoin could continue to face hurdles in the coming weeks. Stick here with us. You're watching Morning Brief.
And that is a look at the opening bell at the New York Stock Exchange and at the Nasdaq. At the Nasdaq, you've got practically a whole football team. Hey, this week is the kickoff of NFL season. Let's go Eagles. Let's get it done. All right, you got Jen Mad bringing the opening bell at the Nasdaq. No doubt they might be Eagles fans. They might not be. We love them anyway. The Vista Energy ringing the opening bell at the NYSE. They're definitely not Eagles fans. I believe it. All right, you're watching the opening bell brought to you the opening bell was there. You're watching the morning brief brought to you by Invesco. Let's do a check of the markets. We're taking a look at the Dow, the S&P 500, and the Nasdaq in negative territory. We wish it was positive. It's in negative territory right now. The Dow is down by about 0.4%. The S&P 500 down by about 0.6%. Nasdaq Composite down by about 0.75% right now, Maddie.
Yeah, it makes sense, right? We're heading into September, a historically tough month when it comes to markets. So no surprise here to see the major averages under pressure here. What's really going to be interesting, though, is what happens come Friday when we get that jobs report for the month. That is anticipated to be a very big potential catalyst for markets because it could define the path forward for the Federal Reserve. So that's certainly something we will be watching here at Yahoo Finance. But while September is that historically volatile month for stocks, it's also a tough month for cryptocurrencies. Bitcoin September returns have typically been negative, and today the token is trading below that key $60,000 level. Joining us for more on this, we've got Sean Farrell. He is FundStrat's head of digital asset strategy. Sean, great to have you on with us this morning. So we have been talking a lot about how September is historically the worst month of the year for equities. How much read-through is there from that seasonal and technical strategy for equities over to Bitcoin? Is September a tough month for Bitcoin as well?
Hey guys, thanks for having me, and go Birds. Yeah, I mean, look, historically it is the worst month. I think if you look at the historical averages, September really is the only month in which Bitcoin has an average negative return. But, we like to advise our clients and subscribers that, you can't just look at seasonality in and of itself. There are some, structural things that are endemic to seasonality, like lack of liquidity that we've seen really take a toll on crypto markets over the past couple of weeks that do weigh on prices. But really, for us, we do think you should account for those seasonal effects, but really be more focused on what the Fed's doing, how liquidity conditions are looking, and make sure that any of these macro factors are superseding any broad seasonal factors that people just slap onto analyses.
And so with that in mind, I mean, what are the biggest events that are still left this year for crypto that investors should be keeping tabs on to try and figure out what the long-term kind of lead looks like for not just Bitcoin, but Ether and even some of the altcoins as well?
Yeah. So the big thing is obviously you had just alluded to the jobs numbers this week. I think, rate cuts, I think a lot of the market right now is skittish about rate cuts, frankly, because historically they have been at the precipice of downturns in the market. But rate cuts are not necessarily bullish or bearish without, taking into account the context in which those cuts transpire. And so, our money is still on the soft landing path. I think a lot of the softness in the labor market isn't as much reflective of a business cycle turning so much as the labor force expanding. And so, I think once we get some, soft but non-recessionary jobs numbers, hopefully this week and, next month, we'll have more investors skew away from that recessionary risk and back towards soft landing into year end, which is very constructive for crypto prices. And then the other thing, obviously, is the election. I think it would be, silly not to view the election as a critical factor that will come into play when thinking about crypto prices. We kind of, our in-house view is that, if Trump were to get elected, that would certainly slap on a premium to crypto asset prices, Bitcoin, a lot of alts that will now have a clearer path forward in terms of market structure and legislation that will support their growth here in the U.S. And so certainly that is another factor to contend with as we go into year end.
Sean, it's interesting too, being able to track some of the mining operations for crypto in the public market as well, and the cost of electricity that some of them are at least monitoring at this juncture, the rise that we've seen comparative to 2019 even. How much is energy, especially considering the kilowatt hour costs, how much is that impacting miners' operations and the returns that they're seeing right now?
Yeah, so a lot of these miners already have embedded PPAs, and so they don't, the volatility around energy costs don't affect them as much in the immediate term. Long term, certainly that is a consideration. I think right now the big concern is that, their unit of account, their revenue line item is right now, well, it's consolidating, it's chopping sideways. But, I would say right now, just high level, the marginal cost of production for a lot of these miners is around, say, low 50s, maybe high 40s for some of the more efficient ones. And so, a lot of them are operating on razor thin margins at this point. So for the miners to really, become more profitable and for that, their equities to benefit from that operational leverage that they do have, we're going to have to see Bitcoin prices go up. I'm not as concerned about energy prices in the immediate term, but long term, certainly.
So when you are thinking about the path forward for investors and Bitcoin holders here, what should the thinking be and the strategizing be for them throughout the month of September, which is typically rough, as you've mentioned, but also as we head into November and have all of these risks to come that are difficult to price in, these unknown unknowns? What should investors be positioning around?
Yeah, so I think what's important, I think it's important to step back from a high level and understand, acute trading risks versus cyclical downturn risks. And if you step back and, listen to Powell at Jackson Hole and think about the Fed's positioning around markets right now and how they've shifted focus away from inflation towards employment, they've kind of taken away the right tail, or should I say the worst case scenario for crypto, which would be a stagflationary period in which the Fed, real growth is slowing and the Fed has to, step up and be hawkish regardless of that fact because inflation is soaring. That's what we had back in 2022. That is the cause of a cyclical downturn. Liquidity conditions tighten, and we possibly head for some economic calamity. That right now is not on the table, just due to the posturing from the Fed. And so you kind of have the scenario where you have either a soft landing and the business cycle continues to expand, liquidity continues to expand, or you have a recession in which I will concede there is significant, acute downside risk, but we are certainly going to meet any kind of recession with, more easing, more liquidity, in which case, Bitcoin will be the fastest horse out of there. And so, the long tail cyclical risks are kind of off the table. I think heading into this, heading into Q4, certainly we recommend keeping a little dry powder on hand for any kind of downside volatility. That's how we're advising clients right now. But we do think overall the risks skew to the upside.
Just lastly, you had mentioned this earlier, Sean, and we know that both political candidates are trying to win the approval or at least get some of the mind share from crypto holders out there or investors. And we know that Grayscale as well, in the Harris poll, they had also run a study asking the question of, is 2024 the Bitcoin election? Is this the Bitcoin election from your perspective? And I mean, even when they ran that poll, it was two different candidates actually. So what could these candidates say that ultimately win over Bitcoin or crypto enthusiasts?
Yeah, I mean, it's pretty simple. I think, it is unfortunate that it has become a partisan issue because I think, there are qualities of Bitcoin that are endemic to Bitcoin that certainly, play to the interests of people who skew to the right side of the spectrum, the political spectrum. But certainly there are aspects of the technology that really play into a lot of the themes around, access to banking services and holding, the elites accountable, that play into a lot of the themes that the left presumably identifies with. So it's unfortunate that it has become partisan, but, I think that, either party, and one has already done this, that supports the freedom to self-custody, to transact, to mine Bitcoin in the U.S. I think that certainly is that's enough for me to label them a crypto proponent. I think another big thing would be to come out and support the proliferation of stablecoins. Stablecoins, I think, are outside of Bitcoin the one product that crypto has created that has clear product market fit. It is a great way to extend the dominance of the dollar while also leveraging this new emerging technology.
Certainly. Sean, great to get some insights from you today, and thanks so much for teeing up and previewing September plus Q4 of this year. We appreciate it. Sean Farrell of Fundstrat. Thanks.
Thank you.
Appreciate it. Coming up, investing like Warren Buffett. We'll break down his biggest portfolio moves next. Welcome back to Morning Brief, brought to you by Invesco. The summer months are typically slow for investors, but billionaire Warren Buffett, he kept busy. Buffett, who celebrated his 94th birthday over the weekend, steadily trimmed Berkshire Hathaway's holdings in Bank of America by more than 14% during July and August. Buffett also unloaded roughly half of his shares of longtime favorite Apple during the summer months. Joining us now is Lee Munson, President and CIO at Portfolio Wealth Advisors. Lee, great to have you here. Thanks for taking the time with us on the day. All right, so first and foremost, what do you think is the strategy behind these moves that Buffett made during the month and recent weeks?
Well, you got to remember, he's been in Bank of America since about 2011. He's done very well in the stock. He's just simply reducing a position. He also reduced some Capital One, which tells us one thing. He doesn't, obviously, big banking isn't what it used to be, and we have to look at what he thinks the long-term prospects are. Also, with Apple, Warren Buffett has made an amazing amount of money on Apple. It's still gonna be his largest position. He's gonna have about 100 billion of it, that he has after these sales. I think investors shouldn't read too much into it. Let me explain this. When you're up 150, 200, 250, 300, 400%, it's okay to take a profit. If you read all of the Berkshire Hathaway annual reports for, last 20, 30 years, he talks about that every once in a while. When you double or triple your money, you can take money off the table. Here's sort of the read between the lines I think everybody's trying to surmise. Are there better prospects other places? And I think when you see these tiny little positions like HEICO and these tiny little positions like Ulta Beauty, you start to think, is there great value in the market outside these big names? And so if you have big winners, you want to eventually take some of that money off the table and push into other areas. I think that that's really the message here. And also, he's sticking with that oil trade. I did not. I understand the story about Occidental. I understand Chevron, but those have not done great over the past few years, and he's still with it.
It's interesting that on the one hand, Lee, you say don't read too much into it. But on the other hand, if you take a look at exactly what you just described, getting a little bit off the top for a company like Apple, that's exactly what analysts have really started to rally around over the past couple of weeks amid this kind of great rotation. We're seeing a bid up in some of the smaller cap equal weighted S&P 500s as opposed to those big tech names. Did Buffett know something that the rest of us didn't, as always here?
Well, I think it was pretty obvious when you have very little breadth in the market and everything's based on this big tech AI trade. Certainly there's going to be a rotation, but I think here you have to think, if you just generally observe the market outside the Mag 7, there are tons of small and mid-sized companies. And I'm just talking about companies that are under $100 billion. You take a company that's 50 billion, market cap, and that's considered small today. They've been languishing for some time. So I don't think it's a really, a too deep of observation. Now, the timing, certainly, I get your point that how did he know that this rotation was going to occur in the summer? And you know what? Sometimes people like Buffett, they just have that magic ability to see things. But he also has a larger crew. There's a lot of people, not just Buffett, that were rotating back into value. I think when you look at the valuations this summer, it just becomes obvious that eventually small cap's going to have to rotate. But also remember, those little positions like in HEICO, like at Ulta, those are tiny sub-billion-dollar positions. He's just starting to pick away. What is happening, a lot of cash is being raised, but there's not a speed at getting into those sector rotation trades into value. I think that that's an even more important point to make. All that dry powder hasn't been spent just yet.
It's really interesting as we're thinking about so many of those dip buying opportunities that may prevail if September holds true and we do see some type of weakness. Where would those dip buying opportunities push Berkshire Hathaway? Where do they push you? Where are those opportunities you're looking at and perhaps keeping some dry powder ready, Lee?
Well, I think you've got to look down the market cap a little bit. Obviously, there's some issues with the election, right? We don't know about how that regulation is going to go. That's going to affect banks and energy. So I'm a little less interested in that area going forward. But I think when I look at where some of the great plays can be, I like to look at beat up retailers. I have my own little list of things that have gotten very cheap. You start looking at some of this low valuations where you're dealing with trades, dealing with people who are in the lower income still. You think of like a Dollar Tree, you think of a Dollar General. You think of some of these beat up retailers like Ulta. I don't think Ulta is really the company you want to go, but anything that's going to get consumer spending on the, starting next year, I think that's where a lot of action can see, because eventually people have to move away from the hyperscalers and AI story and think about where that money is going to flow into. And if the economy is going to soft land and spending is going to continue on, what names have been crushed over the last couple of years, I think that's where you go. So I think a lot of things that have to do with the retail spending trade.
It's interesting, though, because as we've gotten closer to the end of this earnings cycle, you're really seeing a lot of contradiction in these retail names. You've got Walmart on the one hand, and then you've got even Ulta struggling on the heels of their earnings alongside the likes of Lululemon. Where is Buffett finding the clear thesis on which companies are going to be able to continue to benefit from consumer spending as we are starting to see some cracks across the retail sector?
Well, I'm not sure he is. I mean, I'm not here to like argue with the, one of the richest men in the world who's, been on the earth twice as long as me. But let me tell you, when you take a company, like Ulta, I think Walmart's eating their lunch. I think, if Ulta doesn't have anything special, Sephora has something special. If you ask my daughter, you ask my wife about Ulta, they'll say, please, for that type of price point, they'll just pick up those things over at Target. So I'm not, completely, I don't really see a lot in his 13F that suggests he's on that trade again. I think he's still looking at classic Buffett stuff. What's cheap, what's trading for cheap earnings, what there's a catalyst. I think more that I see in that 13F is that he still believes that aero defense and military spending is going to continue. And I see more in what Buffett is looking at, especially insurance, that position in Chubb that he just keeps pushing. He can't not make money off of Chubb. But again, it's his business, it's insurance. I think what he knows best. I don't think we've yet to see those real plays in Berkshire Hathaway outside of Ulta. I think it's something that, you want to keep looking. And just because the first strike in that area of consumer spending being Ulta, I'm more interested in what he's going to buy over the next 6 months. I don't think right now I've seen it yet in the tea leaves when you holdings.
All right, we'll see what those acquisitions or what those purchases in the next 6 months do for this company that's just struck and held above this $1 trillion market cap here. Lee Munson of Portfolio Wealth Advisors, thanks so much. Appreciate it. Maddie, I'll toss things on over to you.
Thanks so much, Brad. Let's turn now to our chart of the day here. You are looking at a chart showing household allocations to stocks as a share of financial assets, and we are at a record high since the 1950s when it comes to household allocation to the stock market. Now, why am I looking at this? Well, this has led to a record number of 401k millionaires, more than ever in U.S. history. So you would think, okay, that's great news for these households, but I want to zoom in to 1990 here. What happened right after that other record in terms of household allocations to stocks? We got that stock market bubble in the early 2000s. So that is another big concern. This drive up in the stock market has been driven primarily by a couple of big tech names. And the big question is whether or not we see any sort of cracks in the AI rally. Certainly a sign of that when we got those Nvidia earnings and the street was disappointed in the guidance moving forward for Nvidia. If that is going to continue to be the story, will we get some pressure on household allocation to stocks? But for now, investors really enjoying those record-breaking returns and the fact that we do again have that record for 401k millionaires. This is another reminder, guys, to get into the stock market if you haven't, because we know that stocks have historically always outperformed wage growth. So if you're able to own companies versus just continuing to work at them, you're likely to have more and more of an income there. And by the way, last thing I'll say, that is one thing that has been a challenge for the Federal Reserve as individuals across the country are raking in more income through the stock market than ever in history. That's what's partially led to a little bit of an uptick in that consumer spending, which has continued to keep inflation up here. All right, well, coming up, we're going to take a look at the equities that you need to watch this morning in our Stocks in 30. You're watching Morning Brief.
Welcome back. You're watching the Morning Brief brought to you by Invesco. It's time now for our Stocks in 30. All right, we're kicking it off with VW. Let's start there. Weighing plant closures in Germany for the first time in the company's history. Taking a look at shares right now, they're up by about 0.1%. Here's what you need to know. They have a plan, and they're going to tell about 18,000 workers at a town hall on Wednesday morning what that plan is, and we'll see exactly what that looks like. But as of right now, that does not mean that they can rule out shutting down factories at this juncture. They also just need to begin these negotiations, especially at a time where they're trying to move more towards their own EV development as well. They've got the Volkswagen, I think it's the ID Buzz is what they're calling it, which is like, you know, the Volkswagen, the big bus, I
love it.
The infamous Volkswagen bus that they electrified, essentially.
There you go. I'm still
cool.
waiting for the return of the VW Bug from high school.
Hasn't come back? We don't have an EV Bug yet?
I don't know yet, actually.
I thought that would be the first one.
That'll be some
I'll
news
report
that we'll
back on
bring
that one.
once I do some of my reporting. All right, so I am taking a look at U.S. Steel in hopefully 30 seconds here. Vice President Kamala Harris saying the company should remain American-owned as it weighs a sale to Japan's Nippon Steel. So this is a really important story to watch because basically U.S. Steel rallied off the heels of this idea that Japan would be able to buy out the company that is in dire need of an infusion of cash. There's a question about whether or not it's going to be able to continue to be domestically owned because of the need of that infusion of cash here. After Kamala Harris said over the weekend, hey, I want this to stay American owned, we have seen the stock under pressure here, the shares dropping as much as 5%. That is the lowest level since June before Biden dropped out of the race here, Brad.
And finally here, let's keep an eye on Unity Software. Morgan Stanley analysts upgrading the company to overweight from equal weight and maintaining their price target of $22 a share. Shares right now trading at about $17.46. It's moving higher, though, here on the day right now by about 6, just shy of 7% here. They say now that they see clear potential for upward revisions in Create and greater stability in Grow, of course, that part of the Unity Software platform there. And so ultimately, they're looking at this as a potential growth opportunity here, continued for Unity Software. And that's Unity. We tried to do it in 30 seconds or less.
I think we crushed it.
I had 15 seconds more worth of commentary on Unity, but we will do that another day. Oh, by the way, just to close the loop, closure for you folks out there, there is a Volkswagen Beetle. ID Beetle coming 2026.
Oh, 2026. All right. Well, you'll be back with us right here. I'm sure we'll still be sitting in these exact chairs by 2026, and we can break that news once again, Brett.
Coming up, everyone, we're getting a fresh read on the manufacturing industry. ISM data right at the top of the 10 a.m. hour coming next on Catalyst.
Welcome to Catalyst. I'm Madison Mills alongside Brad Smith. We're 30 minutes into the trading day. We're watching three catalysts expected to impact markets this week. We've got manufacturing data, Broadcom earnings, and another look at discount retailers.
This is really exciting. ISM manufacturing data coming in, unfortunately, below expectations in August. Now, this comes ahead of a key week for data wrapping up with the jobs report on Friday. We're going to discuss what this means and the latest read on the manufacturing sector signaling about the Fed's goal for a soft landing.
That's right. And we've also got Broadcom, the next big test for the AI trade. This comes after Nvidia disappointed Wall Street last week. The bar is high to get the rally for AI back on track. We'll talk to a Bernstein analyst about what investors need to hear from Broadcom later in the hour.
Plus, we're getting key insight into the weakening lower income consumer with earnings from more discount retailers. You've got Dollar General's report that's showing some signs of concern already. We'll dive into the health of the consumer and what it tells us about the economy during today's show.
But first, let's take a look at some market headlines to start the hour, sponsored by Tasty Trade here. You're looking at the market action about 30 minutes into your trading day here, and stocks under pressure following that weaker than expected manufacturing data. You can see the S&P down over 1% solidly, the Nasdaq hovering near declines of around 1.5%. I just want to run through those softer than expected ISM manufacturing numbers coming in at 47.2 versus 46.8. That was the previous estimate here. U.S. construction spending also coming in weaker than anticipated. And those ISM manufacturing prices, though, coming in a little bit above expectations. That is not what the Federal Reserve is going to be looking for, is signs of an increase in inflationary pressures within manufacturing. One thing, though, that could be a bright spot here, ISM manufacturing employment for August was revised up to 46 versus 43.4 in the previous month. So you're seeing a bit stronger number there in terms of the hiring in this manufacturing data, which could be an indication of where we are headed for that jobs report coming in here on Friday. But I think it looks like the market not only focusing on this data, but also kicking off a rough month for markets here as we get the September trade on.
Yeah, one note within this, they say that while still in contraction territory, U.S. manufacturing activity contracted slower compared to last month. Demand continues to be weak. Output declined, and inputs, they stayed accommodative. Specifically on demand, demand slowing was reflected by a few things. One, new orders index dropping further into contraction. Export orders index contracting slightly faster, and then you also had the backlog of orders index remaining in strong contraction territory, plus customers' inventories index at the just right level. So all of those things considered, some of those factors that played into the broader environment that we're tracking within manufacturing at this juncture, according to ISM.
Yeah, and the lowest new orders for ISM since May of 2023 as well. So just some size and scope for our audience there. But let's get a little bit deeper into the market reaction to the ISM data and why it matters. Last month, we saw stocks selling off right around this time as recession fears crept into the market, starting with softer than expected jobs data and then fueled even further by that softer than expected manufacturing data. With September being a historically weak month for stocks, what can we expect from here? Joining us now on this, we've got Adam Turnquist. He is the Chief Technical Strategist at LPL Financial. Adam, great to speak with you here. So listen, we're chatting with you on the heels of this softer than anticipated ISM data. To what extent do you think this is a sign of things to come as we head towards that economic data we're all watching, which is that jobs report on Friday here?
Hey, good morning. Thanks for having me. Hopefully we're not getting a flashback of that August 5th week when the market sold off. We had a weak manufacturing print, and then, of course, that weak non-farm payrolls report, which will obviously come on Friday. But I think right now the economy is a bit on trial with most of the focus on the labor market. That's going to be the headline event, a drum roll into that Friday morning print, and really going to set the tone for the September rate cuts, whether that's 25 or 50 basis points. I think if we see anything weaker than expected, expect a 50 basis point rate cut. I don't think the market's going to welcome that news, as it did not back in early August. So it's going to be a short but a pretty wild week, I think, here in the markets.
You know, it's particularly interesting, Adam, especially as we're looking through some of the context of this reading this morning, where they added a note saying demand remains subdued. Companies showing an unwillingness right now to invest in capital and inventory due to current federal monetary policy and then election uncertainty. And they added in this kind of tenor that a lot of companies are saying that their inventory levels are just right. So that doesn't necessarily support the need for adding on more jobs in the manufacturing sector. So what does that pass-through mean for the employment situation as well, from your perspective?
At least the employment index or a portion of that did move higher. I think that's a positive sign. But when you look at new orders, a more forward-looking indicator, and that continues to contract, not a great sign. And it's interesting to compare where the ISM data is right now in contractionary territory, with a market trading near record highs, just a few percentage away from those July highs. That historically does not line up. When you have a market within 3% of a new high, on average, that ISM manufacturing data is around 55. So there's an interesting gap between where historically manufacturing is in a strong bull market versus where we're at right now. And again, I think it does suggest maybe we're slowing down. Some of the anecdotes in that survey data are certainly interesting. And it's just more evidence that we're maybe normalizing or slowing down from an economic standpoint.
Adam, prices paid also came in higher than expected, and we're seeing some inflationary themes under the hood of this data print here from the ISM side of things, and we've got that CPI print coming up on the 11th. Are you concerned at all about a reignition of inflation moving forward here, and is that something that investors listening to this should start to potentially position around?
That's not a key concern right now when we look at the economic data. We're pretty comfortable with the trajectory of inflation and eventually reaching close to the Fed's 2% target. I do think it's really about the labor market now. Inflation's moved more to the back burner as we've seen relatively consistent prints that show a deceleration. And with the labor market, there's more volatility, as we've witnessed in some of the data, especially non-farm payrolls, as we witnessed back in August.
You know, Adam, as I'm sitting here looking back in my notes, Bank of America research saying that if we did see another pullback here, one of the key levels technical-wise for the S&P 500 would be 5560. I wonder if we did see a weak September, as history has shown us, and seasonality tends to prevail for one reason or another. This could be the case where we do see another pullback if we also have some economic data readings like this in ISM. What are the key technical levels that you would be watching in that instance?
So right now, when we look on a short-term basis, looking at the 20-day moving average, that's near that level that Bank of America noted. But if we, for example, get, I think, a weak non-farm payrolls print on Friday, I would expect the market to go retest that August 5th low, the 200-day moving average, maybe even down to the April lows around 49.50 on a more volatile type of pullback. I do think we're in for a period of more volatility. That's what the seasonality suggests, the worst month for the S&P 500, not only on an average return basis, but just on a positivity basis, only finishing higher 43% of the time. And what's interesting, when you look at the month on a progression basis, seasonality and that weakness really is a back half story. That lines up right with that September 18th FOMC meeting. So we could be in for a volatile back half of this month as well.
And based on the market reaction right now, it does look like we are turning back the page to the beginning of August in terms of the negative market action that we saw on the heels of the last manufacturing print heading into the jobs data. Where can investors find safety, in your view, amid some of the downward pressure that we're continuing to see across the major averages here?
Right now, as we look at September, our favorite sectors are communication services. You get a bit of a barbell strategy there with some mega cap growth names, but you also have more of those legacy telecom names that can be a little bit more defensive. We also like industrials. Now that sounds like a more cyclical name, but there's some defensive qualities of the industrials, notably the aerospace and defense area there. And we also like the reshoring theme that industrials is part of, along with its AI exposure with building out some of these data centers. And also gold is always an easy one. Dollar moving lower. We think gold breaking out here is another opportunity. We've been positive on precious metals, notably gold, for a while.
Adam, really good insights here. Thanks so much for taking the time here with us on Yahoo Finance. Adam Turnquist, who is the LPL Financial Chief Technical Strategist. Good to see you.
Thanks.
Certainly. The big data point to watch this week is the jobs report. With a rate cut expected to come later this month, Friday's numbers will be one of the last key pieces of data that the Fed will use to weigh their decision. Now, after July's disappointing data saw unemployment tick higher, once again, economists are expecting recovery this Friday with an estimated 163,000 jobs added and unemployment cooling a smidge to 4.2% here. For more on what to expect, let's bring in Corey Cantango, who is LinkedIn's head of economics Americas. Corey, great to see you. Good to have you here on Yahoo Finance with us. So let's just go into your prediction. What should we be expecting going into this read, and what is the story that you believe the Fed will be able to extrapolate from the employment situation going into that meeting where all of us pretty much are expecting a cut?
Well, right now, the expectation is that we'll see some rebound in that non-farm payrolls number. What I'm actually looking at very closely is tomorrow's job openings and labor turnover survey. That's JOLTS. So JOLTS is actually really informative because it's taken at the end of the month. So we'll see the end of July, and that jobs report we're going to see for August is going to be from mid-July to mid-August. So there's actually a lot of information in JOLTS. So that's what I always look at before forming my prediction for what we think the non-farm payroll number is going to look like. But currently expectations that we will see some rebound. It is normal in these kinds of data series to see kind of a dip one month and then a rebound the next month. So I think that's what most folks are expecting. And for unemployment, that's expected to kind of hold. It wouldn't be too shocking if it ticked up or ticked down very slightly. But claims data has showed us that it's looking pretty steady. Initial claims have come down in the last few weeks. Based on the data that we've seen, continuing claims are also holding steady. So there aren't any indications right now that we're expecting to see a bad jobs report on Friday.
Corey, in your role as the head of economics over at LinkedIn, I would imagine that you have access to some great data about the labor market. What is one thing that you think you've been able to see in your day-to-day in terms of the data that indicates the health of this labor market that the Federal Reserve may not be necessarily fully digesting based off of the broader economic data that they are looking at to suss out the health of this labor market?
So right now, what we're seeing on LinkedIn, and we're also seeing some government data too, is that the labor market is still holding up, but it is increasingly fragile. So those areas where we did see a lot of strength in the labor market, that area has been let out. So in the government data, we see healthcare, we see government sector, leisure and hospitality. That drove a lot of those payroll gains. That's off the table for leisure and hospitality. They've recovered from the pandemic. On LinkedIn, what we're actually seeing is that there's been some stabilization in some areas that have been particularly weak in the labor market. So we think about technology, information, and media. Hiring in technology, information, and media has actually stabilized quite a bit since last summer, and it's up compared to last year. So we're seeing that there are some sectors that are beginning to level out, but there are also sectors where they had a lot of steam and they've kind of run out of steam. One area that you also want to look at for this week's jobs report is going to be construction. So construction is one of those areas like tech where we've seen hiring has actually accelerated relative to last year. And that's actually been kind of a bit of a boost in the last few jobs reports.
From what you're seeing on LinkedIn and where there is demand for certain skills as well, how does that kind of translate to sectors that you expect to outperform in coming data readings?
So what we see on LinkedIn is what you would expect. Employers are always looking for these kind of classical, transferable skills like communication and just interpersonal skills in general. And we have seen a rise over the last few years in terms of AI skills, but that's still very niche. So overall, the kinds of jobs that employers are looking for, a lot of them are still in, more traditional sectors. So healthcare, for example, there are a lot of what we call first line jobs. So medical assistants. And, that's a job where, there potentially is a lot of gains that could be made from using generative AI, for example. But overall, those jobs are still very much in demand. So we are seeing that, the labor market, yes, there have been changes in the labor market. We're expecting there to be changes in the labor market because of technological forces, because we are expecting monetary policy to become more neutral. But right now, we're still seeing a labor market that we have been seeing over the last few years. It doesn't look like it did during the Great Reshuffle. It looks more like 2016, 2017, 2018.
Corey, it seems a lot of individuals are also kind of sitting on the sidelines, folks who maybe got pushed out of their roles due to company attrition or even in the smaller case of a layoff, for example. what can they look ahead to that might lead to some hope about the future of this labor market? If the Fed, if and probably when the Fed cuts by 25 basis points at least come September, is the labor market just going to roar back like that, or are they going to have to wait a little bit longer?
Well, it's probably not going to roar back. And the reason for that is that employers right now are anticipating that Fed rate cut. They're building that into their expectations, and they're making their hiring decisions right now based on what they think that rate cut is going to be. So don't expect to see a huge boost in the labor market as a result of the rate cut. But what we should see is that over time, if we get monetary policy back to a neutral stance, is that the labor market will start to pick up a little bit more, especially in terms of hiring. So that's something we're keeping a very close watch at here at LinkedIn.
All right, Corey, thanks so much for bringing us those insights. We really appreciate that. Corey Contanga, LinkedIn's head of economics America, is joining us this morning. Now, coming up, we're breaking down some of the biggest movers on Yahoo Finance's homepage. We'll take a look at those tickers for you right here after the break. Let's get to some trending tickers. In a new letter to customers and partners, Supermicro CEO Charles Liang addressed concerns over delaying their financial report and called some statements in a new recent short seller report false. Shares are moving higher after that letter, and they're nearing an upside move of about 3%. Now, just to get into the context here, right? We've been talking about this a lot on the show. So Supermicro Computer, one of the main chip stocks that has seen a record-breaking rally year to date. Now, on the heels of this Hindenburg research report, the Hindenburg researchers and short sellers saying, hey, actually SMCI is doing so well because they've had some accounting flubs that we're calling into question. Then after that, Supermicro said, actually, we're going to delay our 10K filing. That led Wall Street to think that Hindenburg's report had some validity to it, and we saw the stock continuing to move to the downside off of that. Now we have Supermicro CEO coming out and saying, quote, I continue to have strong confidence in our finance and internal teams in this letter, and that when they announced their decision to delay the 10K filing, we indicated that based on the work done so far, we don't anticipate material changes here. So yet another development in the ongoing saga with SMCI and Hindenburg here, Brad.
Yeah, the expectation coming into this, they were looking for fiscal year 2025 sales in this range of $26 billion to $30 billion here. Now, even though there was the delay that was put out there late August here, there's a larger question of going forward with the demand profile that we've heard from the industry and specifically the poster child for AI chips right now, what that will signal for the rest of the players in this space that we're anticipating a continuation of of consumer demand or customer demand being a rising tide, and Supermicro is largely one of those chips, or one of those ships, I should say, that was relying on its own chip and its own prospects to raise as well. However, Hindenburg Research coming in out of left field with the cold water certainly hit the stock on the day of. It declined by about 20%, if I remember correctly. And so ultimately here, I think shareholders, investors are wise to wait to see what the company has to say more, and the filing itself, to really get more of the details, and if there's any legal proceedings that have to go forward from here, especially considering the position that Hindenburg Research opened up, published, and the allegations that came forward therein. Also, meanwhile, let's stay in tech, but consumer tech, a little bit more on your fingertips. Apple's event might not be the only show in town. China's Huawei is preparing to launch new products just hours after Apple's debut for the iPhone 16, setting the stage here for the latest clash for the two tech giants. There you're taking a look at Apple shares right now. They're down by about 1.5%. I mean, September is typically Apple's month. They run away with so much of the headlines on the announcements of their new iPhone, and of course, as that is the largest contributor, at least the lion's share contributor to their revenue pie, makes up roughly 50%. Now, some quarters more, some quarters less, depending upon where we are in the cycle. But this is supposed to be a super cycle for Apple, which is why this is so critical, because of the AI features that they came late into the game and really touted to so many analysts and investors and developers out there too. However, it seems like some of those features not going to be coming out until later on in the year. So that raises the question of how many first buyers or first movers on the buying side that you're going to see from the customers out there if we're just sitting here waiting to get the OS update.
Yeah.
For those devices.
Absolutely, especially because consumers and analysts and stockholders are anxiously awaiting those AI features as upward catalysts for Apple, the stock, versus Apple, the iPhone maker, right? It's really interesting given the amount of times that we've seen this market be mad at some of these big tech firms for not having a ROI to prove from their AI investments so far. Apple has a very high bar to clear heading into this September 9th event, because the street is going to be looking for evidence that their AI investments and the CapEx that AI investment has required has been worth it for the company here. I also want to point out that Apple shares typically don't do well on launch days. I'm taking a look at a chart right now showing Apple shares have dropped on 12 of the past 17 iPhone launch days. That's according to data compiled by Bloomberg here. But this is also, as a reminder, September, a tough month for stocks. Apple has historically been falling by around 3% during the month of September, so they're going to have to work even harder to buck that trend this month here, Brad.
And, you know, for Huawei here, the IDC data has continued to show that Chinese smartphone market accelerating to 8.9% growth. That was in the second quarter of 2024, and it was led by the Chinese OEMs and Huawei and Xiaomi, large double-digit growth, big contributors to the increased momentum in the second quarter. And so for Huawei, this is critical timing, especially given what the growth cycle is going to look like on the back half of this year. They had noted within their research in the first half of the year, Huawei was the leader in the market despite U.S. trade restrictions, further closing the gap with Apple in the under $600 segment, U.S. dollars that is. So this is going to be a critical announcement to see what they put forward on Apple's big launch day, of course, that they would like to make sure is there kind of like one more big thing that they always come out with as well.
Right, absolutely, Brad. We'll definitely be anxiously awaiting those updates from Apple. But we're also going to look right now at some automakers. Shares of NIO and Li Auto moving in opposite directions. The China-based EV makers reporting delivery numbers that fell from a month ago. Li Auto delivering 48,000 vehicles in August. That is down over 5% from July. Meantime, NIO reported over 20,000 deliveries for the month, slightly less than the prior. You can see that NIO shares moved to the upside over the trading period in Beijing, and same opposite move from Li Auto, down a little over 2% there. But it's interesting, Li Auto is Tesla's biggest rival in China, and they saw deliveries dropping. Meantime, we know that Tesla actually recovered after a rough first half of the year for their EV shipments and deliveries in Beijing. So it's interesting to see that they were perhaps able to take up a little bit of market share from Li Auto. We also know, though, Brad, as we were talking about a little bit earlier, that we saw a recovery in the broader EV space in China over the past quarter. So that could be an indication of the upside move for Tesla, but that makes this even worse news for Li Auto, seeing a drop in those deliveries over 5.6%.
Yeah, just a little more context on NIO here specifically as part of the delivery numbers that we saw come forward this morning. NIO, for them, this was their 4th consecutive month above the 20,000 mark. Now, let's remember, of course, a lot of these companies nowhere near the overall delivery production numbers that Tesla is, but continuing to see some growth is positive. Li, for what you had mentioned, though, that was a slight decline, a move lower, down by about 5% from July's 51,000 figure, but up. Good news, 37% versus a year ago as well. So all in, continuing to track shares of Li, NIO, and XPeng this morning. Yep. Coming up, activist hedge fund Elliott Investment now has a 10% stake in Southwest. So what does it mean for the future of the company? We're going to discuss that next. Southwest's leadership may be in for a fight as activist investor Elliott Management now owns over 10% of the company's stock, allowing the hedge fund to call for a special meeting. Elliott has already called for CEO Robert Jordan and Executive Chairman Gary Kelly, to step down, alongside a proposal to nominate 10 directors to the airline's 15-person board. For more on this, we welcome in Mike Boyd, Boyd Group International President. Mike, always a pleasure to call you in on a huge story like this in the aerospace and the airline industry. Do you think Elliott will be successful?
Well, I don't know what Elliott wants. No one knows what Elliott wants. Elliott has, they want the scalp of Bob Jordan. They want the scalp of Gary Kelly. That's fine. And they want to bring in, quite frankly, a cavalcade of former airline executives to sit on the board, which is kind of ridiculous because American has one ex-airline person on their board. United has one. Delta has none. You don't need those kind of people on your board necessarily. So we're all waiting to see what Elliott really is going to propose regarding where Southwest is going wrong and where they think it needs to be fixed. They've had nothing along those lines yet. It's mostly been talk, and that's of concern.
Well, what do you think Southwest needs to be working on, Mike? What if you were called into this meeting and asked for comment? What would you say?
Well, first of all, we're talking about tweaking it. Number one, they have a system that's worked very well over the years, but it has to be adjusted somewhat. Some of it is just tightening down on their route system to some degree. There's no huge issues here that need to be fixed. It's tweaking things, and one of them is fixing or adjusting their route system. They may need to fly to fewer places like Jackson, Mississippi, where people aren't getting on airplanes, or Havana. Why are you in Havana, for crying out loud? Things like that, or maybe pulling back from Hawaii. But it's things like that. But we've heard nothing like that from Elliott. We've heard nothing about fleet mix. We've heard nothing about the future of what the airline wants to be in terms of an international carrier or whatever. Unless Elliott brings that to the table, we're all kind of in the dark here.
Do you think Southwest could have a successful pivot or larger play that they could grow into as an international carrier?
Well, to some degree, but keep in mind, there's other things that probably need to change. There's that canard that they've only had 737s, which isn't really true. They've had airplanes with the number 737, but these fleets are very, very different. So the fact is, I believe, they're going to have to look at things like going to bigger airplanes. I mean, this love of having 175 seats and no bigger maybe won't work in the future, or having smaller airplanes, the A220, things like that. They're going to have to look at those things. And now they don't have to worry about, if they talk about bringing in another type of airplane, the traditional shareholders would go nuts. Now that Elliott's there stirring things up, I think it's an open event for Southwest to start to suggest things they wouldn't have dared suggested in the past.
It makes me wonder more broadly about some of the other ultra low cost carriers that, to your point, have had success with some of these regional flights that have perhaps been a little bit more of a lower fare generator for them. Are we moving past the availability of those kinds of flights for consumers because it's just too costly to keep them up across the board?
First of all, Southwest is not an ultra low cost carrier. There's barely a low cost carrier. They just produce a good product. But the ultra low cost segment, like Frontier, Spirit, those kinds of airlines, they are in some difficulty because that market is not growing anymore. They aren't ultra low cost anything anymore. And they really can't break into the major markets of U.S. carriers. They've tried, and it just hadn't worked real well. So we're going to see some changes in the ULCC area, and it'll be separate from what's going on at Southwest.
How does that impact the potential path forward for a company like Boeing if we do see that pivot from some of those low-cost carriers?
Well, Boeing has major issues in that they don't have any product in the future. They got the 737-10, which still hasn't been certificated. After that, they have got nothing in that area. And by 2030, they're going to be way behind the curve in terms of being a global manufacturer. I hate to say that, but that's why they were just re-rated again just the other day. So I'm thinking for Boeing, they got big problems in their own industry where, in terms of commercial aircraft, they're falling way behind the curve compared to Airbus, which is the only other global manufacturer in town.
Mike, broadly looking across the entire landscape for airlines right now, what do you think that the state of deliveries looks like and what we should be anticipating and how that affects some of what you were talking about earlier, which is schedules, which is routes that airlines can continue to operate on the existing maintenance that they have to do on the fleets that they have right now?
Well, right now, we saw our Frontier said that the ultra long range XLR airplane from Airbus, they don't think it's going to be good enough. Well, they can't afford it. When you see these airlines like Frontier and Spirit and others intentionally, and I think JetBlue, another one, saying we're going to delay deliveries. If you delay a delivery, like put it out another 3 to 5 years, that's called in the real world a cancellation. But for Airbus, doesn't mean a whole lot. They got people lined up for those spots. But overall, I think these airlines, the ultra low cost carriers, and a few others like JetBlue, they don't need more airplanes. They need fewer.
And just lastly, while we have you here, some news out in recent days, Cathay Pacific, they're one of, or at least they had identified and issued within their Airbus 350 fleet, and looking at one of the engine components there, I wonder what your read into the situation is between Cathay Pacific and whether that's a broader thing that could blow up even more so for Airbus here at this juncture.
Well, of course, we have the RTX engine thing that's come about. Any number of those things can come about with those engines, which we don't know. So that'll develop across the future. But right now, if you're going to have a situation that delays deliveries, this would be the best time to have it. So I don't think it's going to be lethal to a Cathay Pacific.
All right, Mike Boyd, we're going to have to leave it there. Thanks so much for joining us. Mike Boyd is with Boyd Group International as the president. Thank you. Well, investors are still awaiting quarterly earnings results this week from discount retailers Dollar Tree and Big Lots. Investors continue to look for more guidance in the retail and consumer sectors here. Last week's disappointing earnings miss from Dollar General caused shares of the company to go down over 30%. So should investors be worried about low-income consumer spending? Our very own Brooke DePalma is here with more. Brooke, I keep saying that the word for retail earnings this cycle is contradiction in my eyes. I feel like you could just pick your story wherever. Where are you finding clarity specifically for those lower-income consumers?
Yeah, I think that it really kicked off with what we heard from McDonald's. They were one of the first companies to really point out this softness among low-income consumers. Now, we've seen that as sort of a theme following into the earnings. Of course, when we heard from Dollar General, the miss that we saw there, that then caused Dollar Tree shares to fall around 12% in the last 5 days. And it really is spooky investors that this low-income consumer is having a hard time keeping up and being able to go out and shop. And so for Dollar Tree, they're expected to report before market open tomorrow on Wednesday, September 4th. Sales are expected to jump around 1.5%, but Dollar Tree is really expected to lead that. We know that Dollar Tree is testing out this multi-tiered offering where they come in with different price points. That's something that consumers are seeking, but Family Dollar, that other business that Dollar Tree owns is expected to offset, and we're expected to see further softness there from disinflation, markdowns. Discount retailer Big Lots also expected to report this week. We're expected to see a decline of 6.4% there. And then if you take a look at the CPG business, this is a business that's supposed to be doing well across income cohorts as consumers really have turned to grocery compared to going out and dining out. But you know what we've heard from Campbell's CEO telling Yahoo Finance specifically is that there still is an extremely tough environment for low-income consumers. Hormel also expected to report. There is expected to be weakness around their turkey meat category. We know that consumers are looking for cheaper proteins these days.
Yeah, absolutely. Brooke, thanks so much for keeping tabs on the consumer and the retailers across all
Very choosy.
Of the different touch points. Yeah.
Very choosy consumer these days.
Indeed, looking for value out there. Thanks so much. Guys, coming up, Broadcom is next. The next big AI stock to report earnings here. Can it get investors excited about AI again? We'll get an analyst take on that next.
Shares of Nvidia hitting a 3-week low to kick off the month this morning. This comes amid broader pressure on the chip sector following those Nvidia earnings. The next big test for semiconductors, we've got Broadcom earnings expected this Thursday after the close. So can Broadcom meet the moment and reignite the hype around the chips that power AI? Joining us to discuss, we've got Stacey Razgon. He is a senior analyst over at Bernstein. Stacey, it's always a pleasure to speak with you. So I know you've got an outperform here on Broadcom. What are you expecting as we head into those earnings on Thursday?
Yeah, you bet. So I like Broadcom. Broadcom's got a few pieces. So they do have the AI story, which I was classified as the second best AI story in the space. They make chips for the hyperscalers like Google and Meta that are actually working on their own chips. Broadcom does that design work for them. They've also got a big play in AI networking. Couple things that I like about it going into the print. So I feel like their AI guidance for the year has been reasonably conservative. They're guiding 11 billion for the full year, which is a run rate in the second half that's actually a little lower than where they were running in Q2. So that feels like a decent setup on the AI front. And while their core business has not been great this year, they're not the only ones. It's cyclically low. I think they've cut it enough. Marvell's earnings last week were a little supportive there. Some of their end customers have reported. I think that setup into next year looks good. In the meantime, the AI piece has been strong enough to bridge any issues with the core business, so their numbers have still been going up rather than down. They've also started, they've also got a pretty sizable software story. They just bought a company called VMware, which does virtualization. I feel like that there is probably upside as you look through expectations for the software business as we go into next year. The numbers are very, I think that are currently in the sell side numbers, very conservative. I think there's good upside on the software. And even just look more broadly, I would say it's got some of the best operating metrics, margins and free cash flow and everything else in the space by a mile. And it's still very inexpensive. It's at a pretty sharp discount to the broader semiconductor space. For a company with, again, it's almost half software, great AI story. It feels like the multiple is easily supported, I think, at current levels. I actually really like Broadcom.
And so with that in mind, Stacey, and great to see you again, as you think about Broadcom and VMware becoming accretive to the business, what type of contribution are you expecting Broadcom to be able to extract from VMware that flows through to its earnings?
Yeah, you bet. So, I mean, a lot of it flows through the earnings. Software in general has very high contribution margins. Right? What they've suggested is that they believe they can be doing, they guided to about $12 billion in total revenue this year, fine. They think it's probably doing $4 billion a quarter by Q4 or Q1. Again, if you look at what's in the numbers going forward next year, next year, the street's not modeling much more than $16 billion for the entirety of next year, so they're not modeling a lot of growth off of that run rate. The company believes that they can grow this business in the double digits like for the next 3 years. And again, like Hock Tan runs this, so usually when he puts a target out there, they're pretty good at hitting it. There's an old saying, like, in Hock we trust. But it does look like they're on that path, and I don't think the current estimates around that business are aggressive at all.
Hey, Stacey, just zooming out a bit, we got that data this morning from the Semiconductor Industry Association saying that sales data in the semi space was below seasonal trends. Is that a concern to you?
No, so that's the monthly data. It tends to be a little noisy.
Okay.
You can take a 3-month outlook, which like a rolling 3 months, which is actually the public numbers that they put out, and it's a little more supportive. You have to also remember a lot of the growth in the industry, like both positive and negative recently, has been memory. I think non-memory was still up by, I can't remember, 6% or something year over year. I think more broadly, though, in the industry, you have to remember, like currently, it's been a very asynchronous cycle. Some end markets have been very bad. Some of them have hit bottom. Some of them are past bottom. Some of them are not. I'd say things like PCs and smartphones, they're not great this year, but they'll probably grow a little bit versus last year. AI is clearly off the chart strong. Traditional data center is fairly weak. Again, go back to Broadcom. Their networking guidance for this week for this year is pretty weak. Broad x86 server chips from Intel or AMD are pretty weak. Industrial's rolling over pretty hard. It's actually been rolling over for quite a few quarters. I think there's some hope that we may have found the bottom. I think it sort of depends. Some companies have, some have not. And then automotive has sort of been the latest cycle. And by the way, I've been nervous about auto for a while. It's held in much better than I ever would have thought. It is now starting to roll over now, and that tends to be take a little longer. And so it's been a very asynchronous cycle. What that actually is the effect of doing overall is sort of stretching the entire thing out because you have different end markets that are rolling and recovering at different times. But I don't think you can look at the entire industry in aggregate at this point. I think you do have to pick and choose which parts of the market you're looking at, which parts of the market you want to be playing in.
All right, well, then we got to talk about Nvidia. It's down 8% today. What's next for this stock?
Yeah, but I don't think it's down in isolation. Lots of things are down today, so it's not in Nvidia. So look, they had earnings last week. The print was actually was very good. It was fine. The issue that people had on it was not so much the revenues, it was the gross margins. They're guiding gross margins down a little bit into the end of the year. I don't actually think they're guiding them down that much. It's just mixed as they have some of their newer products ramp, and because it's early in those ramps, they have not yet optimized the cost structure. So I think that you'll be fine. Like they're not suggesting that margins are collapsing. They're I think into Q4. They're probably looking for like a 73 or 74% down from like 75, which I mean, part of me wonders why we're even arguing about margins that are that high. But that was the primary concern on the call. It wasn't so much the numbers or anything else. I think beyond that with Nvidia, the question now is, they're launching their new product. It's called Blackwell. There was a little bit of a delay. It doesn't seem to be impacting anything all that much. The big question is just what kind of an inflection is Blackwell going to drive next year? What kind of growth does it drive next year? I still don't think the numbers that are out there right now, at least on the sell side, are incredibly aggressive. Buy side expectations are higher. But it does seem very plausible that product cycle, once it starts going, could actually potentially drive another major reflection. That is going to be what probably drives the stock like into year end. I think right now people are worried, kind of treads water a little bit until those products actually get into the marketplace, and I get that. But once they start ramping Q4, Q1, I'd expect, if that ramp is solid, I'd expect the stock to probably follow.
Stacey, I only got about 45 seconds left. I've been nerding out over CUDA, which is this compute unified device architecture, and some of our viewers might already well know it, as that's been part of the thesis around NVIDIA. How much of that is still driving the investment thesis for NVIDIA versus other factors of the business here?
Well, yeah, it does drive it in the sense that people always ask, what is NVIDIA's moat? And that is certainly part of it. Like, it's not enough to have, if you're a competitor, it's not enough to just have a competitive chip, right? There's the chip and the silicon and also the hardware ecosystem and the systems engineering and the software and everything else that goes around it that creates that moat. And in fact, some of their competitors like AMD have been, because they have not been able to develop that organically, they've been trying to acquire it. AMD just bought a company called ZT Systems, which actually brings in systems expertise. It was sort of a 1,000 engineer acqui-hire is what it was, but they're trying to bring in that systems expertise that they are now realizing that they need. AMD's also doing a lot of work around their own software. They call it ROCm. Intel has a software that they call it One API. They're all kind of work to work on this. But you got to remember, NVIDIA's been building out CUDA for 15 years. Once ecosystems get entrenched, it can be very hard sometimes to dislodge them, and NVIDIA at this point is pretty well entrenched.
All right, Stacey, great to get your insights and perspective, as always. Stacey Rasgon, who is the Bernstein Senior Analyst. Good to see you.
You bet.
Thanks. We've got all your markets action straight ahead. Stay tuned. You're watching Catalyst. We're taking a closer look at some trending stories on Yahoo Finance. Let's start with Airbnb. They're asking New York City to scale back its regulations for short-term rentals. New York's Local Law 18, it requires short-term rental hosts to get a license from the city, verifying compliance with occupancy rules and building codes. Now, Airbnb says the rule has, quote, failed to deliver on the promise to combat the housing crisis here. Now, for Airbnb, we do know that a lot of, and it's even more so than Airbnb, there are many leases that even when you sign them, you're now, if you're reading through the fine print, there are clauses that are put in by many landlords saying that you're not going to actually Airbnb your place out. So in addition to the New York law, it's also the landlords that are having to come around to this too.
Yeah, it's a really good point, especially because New York City's position, at least from the perspective of Mayor Eric Adams, is that this is about the housing affordability crisis happening in the city. And the idea was that, pushing back on Airbnb would lead to more availability of housing. Airbnb is actually using that to their advantage in the pushback here, saying that there has been no increase in affordable housing in New York City. So therefore, why would you continue to put pressure on Airbnb? We do know a judge had previously dismissed Airbnb's countersuit of the city. So we will, of course, continue to monitor that moving forward. But other hospitality news here, thousands of hotel workers are on strike nationwide. Starting on Sunday, workers with the Unite Here union walked out of hotels owned by Hilton, Hyatt, and Marriott. They're calling for higher wages, fair staffing, and workloads, and the reversal of COVID-era service cuts. Now, this is really interesting given that they did this over the course of one of the busiest travel weekends of the year here, Labor Day weekend. Again, 10,000 hotel workers across the country striking here. Some of the cities, for those who are traveling here, that are going to be impacted, at least over the next couple of days, we've got Boston, Greenwich, Honolulu, San Diego, San Francisco, and Seattle, among others. But we also do know that some strikers have been authorized and could begin working anytime in some of the cities where they were striking over the last couple of days here, Brad.
Yeah, it's particularly coming at a time here, too, where a lot of these workers also know how much capacity and pipeline development all of these hotels have. And so there is a lot of money going towards building out, but some of that also for the hotel workers, that's what they're pushing for right now. And another big travel story, Cathay Pacific announced an engine component failure in 15 of its Airbus A350 aircrafts. Now, those planes, they use Rolls-Royce engines. We saw shares of Rolls-Royce. They initially fell on the news, but they're bouncing back, as you can see right here, up by about 2%. Dozens of Cathay Pacific flights are canceled this week as the issues are being repaired. We'll continue to track the stock movements surrounding this story as it relates to Rolls-Royce, as well as the airline operators here that also have A350s within their fleet, too.
Yeah, just for those travelers out there listening, Cathay Pacific saying that it was 15 of its Airbus planes that required repair after an engine component failure. And all of the investigations into this took place after a plane took off from the Hong Kong airport and then was required to dump fuel over the sea for about a half hour after being able to return to the airport. So continuing to see some pressure in the company in terms of looking forward here, how they're going to handle these inspections moving forward. All right, well, coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Brad's going to stick around for you right here for the next hour, so stay tuned for more.
Well. Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks to grow your money. On today's show, the market's bracing for a tough September. We've got tips on how to navigate the volatility and a look at where the market could be broadening. That's next. Plus, planes, trains, and automobiles. Millions hit the road for the busiest Labor Day weekend on record. We're taking a look where consumers are still feeling the pinch of inflation in travel. And plus, a new Medicare rule will mean that there's potentially major savings for millions of older Americans next year. A pro from AARP joins us with more on how to save big on prescription costs. All that and much more, but first, let's take a look ahead at the top stories to watch this week. A big week in labor market data on tap, with Wednesday's JOLTS and Thursday's ADP payrolls numbers setting the stage for Friday's much anticipated August non-farm payrolls report. These will be some of the final pieces of jobs data ahead of September's Federal Open Market Committee meeting. That's where most analysts are expecting a rate cut of at least 25 basis points. Another big story to watch this week is Broadcom's quarterly earnings. That's on deck this Thursday. The country's second largest chip maker by market cap is up around 45% year to date. But after Nvidia's underwhelming earnings report last week, investors will be looking to see if the AI boom is beginning to plateau. And finally, retail earnings are on the front of minds, top of minds. They're on the front step for investors as discount retailers Dollar Tree and Big Lots report their quarterly earnings. That's coming later on this week. After last week's Dollar General earnings miss, shares, they dropped over 30%. Worries about low-income consumers spending, and that worry remains high. All that and much more that we've been tracking. And so, for what all this means for your portfolio, let's jump into today's market action. Stocks are falling a little over 90 minutes into the trading day. Key economic data points on the calendar for this week. How can investors best set themselves up for success? I'm joined by Dana D'Auria, who is the Co-Chief Investment Officer and Group President of InvestNet Solutions. Dana, great to have you back here on Yahoo Finance with us. First, as we get all of these different readings over the course of this week, which one should take center stage for investors who are watching out for what is historically a weak month of trading?
Yeah, I think, certainly the jobs report is going to be a singular focus, I think, really just from the standpoint that, we had our Fed chair come out and more or less guarantee us a rate cut in September. And when you get that kind of dovishness, the market thinks, wow, maybe it's a 50 basis point, not a 25, right? So I think really, what the jobs report is going to be meaningful in terms of, the expectation it sets with the market. Quite honestly, though, I think either way, I'm not expecting a 50 basis point cut. I think Powell needed to reassure, he felt that he needed to reassure everyone that the rate cuts are on the way. There has been chatter that it had taken too long to begin with. So, I think it was important, and he thought the signaling was important. I don't think that means we're getting a 50 basis point rate cut regardless.
So are rate cuts and 25 basis points as it may be and is expected, is that enough to offset what is typically the seasonality that we would see in September?
Yeah, it's a good point. And obviously no guarantees about anything, but we do tend to see that. There's a big question I think investors are facing right now. Are these rate cuts coming because it's just time? We're high, we've defeated inflation, unemployment is still low. And so it's time to avoid the potential for a market correction or a recession? Or is it coming because we kind of are already looking out and anticipating some weakness? And I think, if you fall in the camp of the latter, where you think that there's some weakness coming and that we have to get rate cuts going in order to avoid that weakness, then I think, the 25 basis points may not cut it, just from the standpoint that it's already priced in at this point. It's been expected for quite some time now.
So with that in mind, we've been keeping close tabs on the tech sector, as historically we've also seen that be one of the biggest beneficiaries during rate cutting cycles. And so is that, especially with the setup that we have right now, where it seems like more investors are apt to take profits where possible and then broaden those investments out elsewhere, is tech set to perform differently? And if we do see some of those dollars being reinvested elsewhere, where does that broadening narrative start to really prevail?
Yeah, it's interesting what happened with Nvidia, right? Because I mean, it wasn't a bad report by any stretch of the imagination, but you just have these overwhelming expectations on tech right now. Of course, we are seeing the broadening out that you're speaking of, and it's been a good thing, I think, for the market. So many discussions I have with advisor firms and just home offices who are looking at these indexes and this very top-heavy, concentrated view that you get when you're in a passive investment, and kind of grappling with whether they should be actively managed and, kind of front run what the market is doing, create some breadth here, even out a little bit from a, 1/n perspective as opposed to a market cap weight perspective. So, my overall on this is that from an investing perspective, I am definitely a proponent of kind of trying to tilt a little bit towards these smaller areas, maybe more value-y areas of the market. But that's more of a long-term play, right? And I think that from a market perspective, there's no guarantee that you can expect, again, it falls in the camp of if we're going, if these rate cuts are coming and we've avoided, the worst, the headwinds, and we really do stick this landing, that's great for small caps. Small caps are interest rate sensitive. They rely on capital markets more for funding. So that would be a great thing for them. If we're headed to a correction and a recession, small caps are going to suffer, and typically they will suffer in that kind of a period more than large caps. But if you wait it out, you can benefit on the long run anyway.
Just lastly, while we have you here, Dana, and you mentioned NVIDIA, and naturally that takes us into the conversation of where AI and the trading thesis around generative AI stands right now. Where do you think we are within that larger cycle here, as a lot of investors are waiting for real return on investment from the big capital expenditures that have been put forward by companies?
Yeah, it's so interesting to compare it, right, to the internet, the .com era, and, all the expectations there. I mean, certainly, the internet .coms, this thesis was 100% correct, but there was a lot of fallout before we actually got there, right? And this is so often the case with new technologies, that being right about the thesis and actually making money on that thesis are two very different things. It wouldn't surprise me at all. And, I'd say my base case for AI is probably that it looks something like that it takes some time for these types of productivity improvements, efficiency improvements that we're expecting from AI to really penetrate the economy in a way that you see a productivity increase that actually translates to a better bottom line for companies that are receivers of this, not the Nvidias, the creators, but the users. And I think that's going to take some time. I think it's going to be chunky. Some companies are going to be leaders, and other companies are going to talk a lot about all these great things they're doing, and they're not really doing anything at all with AI. What they're doing is standard tech stuff. So I think making money on this and the thesis is probably a slower, longer burn than maybe the market is pricing at the moment.
All right, Dana D'Auria, who is the InvestNet Solutions co-CIO and group president. Dana, great to see you. Great to have you here on the program with us.
Thank you.
Appreciate it. Coming up, did you travel this past weekend? You definitely weren't alone. We'll break down the numbers when we come back. If you were stuck in long lines at the airport this weekend, then there's good reason for that. The TSA said it was expecting their busiest Labor Day weekend ever, with an over 8.5% increase in airport screenings since a year ago. So what can this past weekend's holiday travel numbers tell us about how consumers are spending their discretionary dollars? For more, we're joined by Robert Sinclair Jr., who is the AAA Northeast Senior Manager here. Great to have you back in studio with us.
Good to be here.
Okay, so, I mean, in summation of what we can make from this weekend, did it hold up to expectations?
It was pretty busy. TSA, record number of those traveling, and we didn't do our usual travel projections, but if you look back at the 4th of July, 70 million overall traveled, 60 million drove, 7 million flew, another 2 or 3 million took a cruise. I think the numbers are even higher for this past weekend. And you want to know why? Look at the price of gasoline. It's down nearly 50 cents compared to a year ago. About $3.32 now. We're down 2 cents in the last week, 15 cents in the last month. But, there's a strong but. We did a survey a couple years ago in pre-pandemic asking drivers what the pain point was for the price of gasoline. 40% said $3 a gallon. Okay. And at that price, they'd have to cut back on some other area of the family budget in order to drive. They wouldn't eat out, they wouldn't purchase a major appliance, something like that. So we're still in rough territory for a significant portion of the population. The Conference Board says 40% of Americans don't have $400 for an emergency expense. We did another survey back in 2018, and again, 40% said they did not have $1,000 for an emergency vehicle repair. So things are good, and they'll probably get better as far as gasoline prices are concerned, what with the OPEC Plus announcement. 8 nations going to pump out an additional 180,000 barrels per day starting in October, and wholesale gasoline is just over $2 a gallon. Usually for the retail price, you had 80 to 85 cents. So things look good for that core 40%, and everybody else that's driving.
And so with that in mind, as we've spoken with so many different retail executives over the course of this past earnings season, and in this current earnings season rather, many of them are talking about where consumers are trading down, and for that we've largely heard about the good side of the equation. But thinking of services, what does a trade down for consumers look like in the services and the experience economy, and how that translates through to travel as well?
Well, as it relates to us at AAA, I think it means older cars in the driveway. I think the average vehicle these days is about 11 and a half years old. 11 and a half years. That's significant. And with prices on new vehicles still relatively high and electric vehicles very high, I think it's going to be the trend for a while, that the people are still suffering from the effects of inflation. One thing, though, that might make a difference is that diesel is also much, much lower.
Really?
And everything gets delivered.
Why is that?
Probably the overall state of the oil markets. There's lots of oil in the markets. I think demand has a lot to do with it as far as the gasoline side is concerned. We're seeing that demand was upwards of 9.5 million barrels per day during the summer, but during busy summers, we've seen 10.5 million barrels per day. So there's a serious retrenchment as far as that's concerned. But with the lower price of diesel, that means the price of getting goods and services to market is going to be cheaper. Hopefully that'll get passed on to the consumer, and that will help ease inflation, and that will help everyone.
Yeah, it looks like today Brent crude falling below $74, the lowest mark we should mention in 2024, and that's on the report of a deal imminent to restart Libyan oil flows. You know, all of these things considered, from what we can take from the holiday, or this holiday travel weekend, but also the summer travel that we've seen, what does this set up for now, the holiday travel season, once we get into November and December here?
I think it's going to increase. AAA is one of the largest leisure travel agencies in the country, and we're seeing that travel to Europe, as usual, is strong. But travel to Asia is picking up. You have to remember that Japan and China were locked down, severely locked down during the pandemic. So I think there's a lot of pent-up wanderlust among people who want to go to that part of the world and see what's going on. And we'll see come Thanksgiving and the rest of the year. It was interesting, one of the top destinations for the holiday, top U.S. destinations, was Anchorage, Alaska, which was number 2 after Seattle.
Just getting out of this heat wave, just going to Alaska.
Nothing like hot weather.
Jettison me to the North Pole, yeah.
So I think people were flying to Seattle. Number 1 international destination was Vancouver. So people are flying to Seattle and Vancouver, catching a cruise ship, and going up to Alaska.
Wow, really interesting. I always value your insights. Robert Sinclair Jr., AAA Northeast Senior Manager. Great to see you.
Good to see you.
Absolutely. Everyone, Costco announced its first membership fee increase in 7 years last month, and the new prices took effect on Sunday. Here with what you can expect from that is our very own Brooke DePalma. Hey, Brooke.
Well, Brad, it finally happened. Costco raised its membership fees after the company kept saying it's a matter of when, not if. The last time Costco raised its membership fees before Sunday was in June of 2017. Effective September 1st, it will now cost $5 more for a Gold Star membership, meaning $65 instead of $60, and $10 more for an executive membership, meaning it now costs $130 compared to just $120. Now, keep in mind, if you already paid an annual fee before Sunday, don't worry, you don't need to pay the difference. But when you do renew come next year, you will have to pay the new higher prices. Now, this fee increase will impact around 52 million memberships, the company said, with a little over half of which are executive memberships. And a quick note for Costco investors, this fee increase is expected to boost membership fee income growth by high single to low double digits, giving a boost to full year earnings. And this decision comes after Costco has been doing well. Most recently, quarterly report, the company beat across all key metrics, including earnings, revenue, and same-store sales growth. So it was a matter of when, not if, and it happened.
All right. Well, I guess I still have to go there to get my gold bar at some point or another here. Brooke,
Online, Brad, only online.
really? That's it?
Only online.
All right, cool. Brooke, thanks so much. Appreciate it. Coming up, everyone, Medicare is now able to save seniors millions on prescription drugs, but could those savings trickle down to you? We'll find out from an expert that's coming up next. While inflation is moderating, many Americans still feeling the impact of higher prices, especially senior citizens. Higher Medicare costs and drug prices have created financial burdens for millions of adults since the pandemic, but relief is on the way for some. A new report out from AARP had found that 1.4 million Medicare Part D enrollees who reach the new out-of-pocket cap between 2025 and 2029, they will save an average of $1,000 or more in 2025. So here to weigh in on the report is Lee Purvis, Prescription Drug Policy Principal at AARP Public Policy. Lee, great to have you here. Just help us break down some of these changes a little bit more. What should people expect?
Yeah, this is a really important new protection for people in Medicare prescription drug plans. Previously, there wasn't a limit on how much people had to spend out of pocket every year. And starting next year, there's now going to be a $2,000 out of pocket limit for everyone in Medicare prescription drug plans, which is incredibly important for people facing high costs.
And so with that in mind, how many people do you think could be potentially affected by this or fall under this new change?
It is quite literally millions of people. We know people were facing very high prescription drug costs under Medicare. And we took a look at how many people would be saving going forward and found that between 3 and 4 million people will be saving between 2025 and 2029. And that number will actually be increasing over time.
Is there a limit to the type of medication that this is applicable for?
No, as long as your prescription drug plan covers the drug, it will apply to that out-of-pocket cap, and you will see those savings.
In the near-term period of time, too, we always like to give people some tips, how they can make sure that they're reducing some of their either Medicare or even healthcare costs while making sure that there are simple things, whether that be like what we've heard proliferate around social media, which is just, hey, just ask for a receipt or ask for an itemized version of that invoice that you get after any type of experience in the medical industry. All of these things considered, what are some of those top tips that people can still be deploying to get the most savings out of their own Medicare or even medical procedures?
Yeah, that's a really important question, and we do get that a lot. And we do have a number of tips that we recommend. The first one, of course, is talking to your healthcare provider. A lot of times when you're taking an expensive prescription drug, there is a generic version or a less expensive alternative available. Something else that's important for people from Medicare, specifically in the prescription drug plans, is looking into the low income subsidy or extra help program that can reduce or eliminate a lot of your prescription drug costs. Another important option, especially for people in Medicare, is looking into your state health insurance assistance programs. Those are available in every state and can actually provide individualized assistance for your Medicare options. And something else we always like to point out is that sometimes the drug companies themselves can be helpful. Oftentimes they'll have a patient assistance program, and if you can qualify, you can actually get their products at a lower cost or even for free.
And with that in mind, you know, as people are trying to figure out what if the prescription that they need is not covered, how can they make sure that they're deploying their options correctly to get the lowest price on that prescription as well?
So I cannot overstate the importance, especially for people on Medicare, to look at their plan options every year during Medicare open enrollment, which runs from October 15th until December 7th every year. You need to take a look at what plans are available to you and make sure that that plan covers the drugs that you are taking and covers them at a cost that you can afford. So that is first and foremost the most important thing you can be doing every year. The second is if you find yourself in that situation, talk to your healthcare provider. See if there's something else you can take to treat the condition you're trying to treat that comes at a lower cost and is covered by your plan. So yeah, very important for people to keep those lines of communication open and again, make sure they're in the best plan for them.
Lee Purvis, who is the Prescription Drug Policy Principal at AARP Public Policy. Lee, great to have you here on the program with us. Appreciate it.
Thank you for having me.
Certainly. Everyone, coming up, we've got another episode of Stocks in Translation. Yahoo Finance's Jared Blickreed. He speaks with Todd Sohn, who is the ETF and technical strategist over at Strategic Securities on the latest market moves. You don't want to miss it.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Welcome to Stocks in Translation, our essential conversation cutting through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need for your portfolio. Today, I'm joined as always by Sidney Freed, and our special guest is Todd Sohn. He is the ETF strategist at Strategas Asset Management. Welcome, guys. Today, we're going to take a walk on the passive side with ETFs, or exchange-traded funds, which is our phrase of the day, what every investor needs to know and understand about the structure of the tech trade and those flows that we've been seeing recently. This episode brought to you by the number 73. That's the percent of S&P 500 companies that are beating on earnings this quarter. We're only a few weeks in. What big bank earnings are signaling ahead of big tech on deck from Alphabet and Tesla this week? And Todd, let me get your big picture overview here. How are you seeing the markets? Because we just went through a very nasty rotation last week.
Yeah, well, first, thank you very much for having me. It's great to be here. I think big picture, it's still a structural bull market. Right now, there are concentration risks depending on the type of fund you may be investing in, right? Large cap funds. But last week's rotation also speaks to the growing durability of this market, right? You're now seeing small caps participate. And I like the idea that many corners of the equity market have been in bear markets for roughly 2.5 to 3 years. The non-tech corners, financials, healthcare, materials, all those areas are just starting to work again after a really challenging environment. So we think that keeps the big picture structural bull market intact.
Yeah, we're going to talk about all these market moves. First, want to break down and get into our phrase of the day, exchange traded funds, or ETFs. And this is just so we can kind of broaden the discussion going forward here. Now, here's a dictionary definition. An ETF is a type of investment fund trading on stock exchanges composed of a basket of assets like stocks, bonds, commodities, or cryptocurrencies. It offers diversification, low costs, and can be traded throughout the day like individual stocks, as opposed to a mutual fund. So Todd, tell us, I know you trade exclusively ETFs, correct me if I'm wrong. What do you like about these vehicles?
So ETFs are great for, I'd say, 5 reasons. They are low cost. They give you access to virtually any market around the globe and different types of strategies now. They are transparent, right? I can look at the holdings every day. I know what ingredients are in my investment. They are liquid. I can trade them throughout the day if I wanted to, or if I'm a large investor, I can move large amounts of money to these funds. And they're tax efficient, right? Taxes are basically deferred because of ETF's secret sauce until you decide to make the selling point. So the combination of those 5 points makes them a really great wrapper for investing, especially over the long term.
And those 5 points sound like great points for someone who is early to investing, someone who maybe doesn't want to pick a bunch of stocks. Or should you kind of lean more heavily on ETFs if you're, let's say in your, even before your 20s, you're 18, you're 19?
Oh, absolutely. You can buy an S&P 500 fund for 2 or 3 basis points. That's nothing.
And a basis point is 0.01%. So
I always get that confused. I have a follow-up question. So what's the biggest difference between a mutual fund and an ETF? Because I feel like those get very mixed up in my mind.
Primary difference is that you can buy and sell an ETF all day long. A mutual fund only trades once a day at 4 o'clock, right? That's when it gets priced. That tells you the value of the fund. Whereas an ETF, I can buy it right now at 1 o'clock and I can sell it at 3:30 if I wanted to. There's a lot of other little nuances here and there, but that's basically the idea of it, that I can trade it whenever I want.
I want to get back to our markets discussion. We were talking about small caps and that painful rotation. First of all, when I think small caps, I think IWM. That's a ticker that's been around the longest, but there are a lot of other ones as well. What do you think this move in small caps is saying about the market? This finally something else is catching up.
Right. So for small caps, the Russell 2000 index, which is an index of all the small cap companies out there, it's in the 4th longest streak historically, or 3rd longest actually, my fault, without a new all-time high. It's been 675 trading days. That's
so not necessarily a streak you want, but here we are.
Yeah. So if I'm thinking about, okay, did I miss the move after last week? Not necessarily. It's the same thing after the bear market of 2000 and the bear market of 2008, right? You may have thought you missed the move initially, but there was a lot of room for growth following that. And so I think A, you can still tilt to small caps if you wanted to, if you're missing that exposure. And B, this just reflects the more participation. More stocks are going up. That is essential for a bull market to continue.
Yeah, and I think let's get to that concentration argument, and because it was well founded. We had the Mag 7, really the Mag 5 carrying stocks at the beginning of the year, and there wasn't much of a let up there, but only within the last 2 weeks, we've seen a lot of other sectors come alive. And it's not like this only happened in the last 2 weeks. Financials have been hitting all-time highs, industrials, healthcare. And this is kind of the way the market generally works, where you have things staggered. You don't necessarily have every single S&P 500 stock hitting record highs at once. So what do you think about the move that we're seeing in some of these other sectors? What do you like?
So financials are really interesting to me here. And it's not just the banking stocks. Banks have had their issues over the last year or so when we had those bank failures. But I look at some of the big asset managers, right? BlackRock, Goldman Sachs, those are all acting much better. KC is an ETF I like to follow. That is a Spider Capital Markets ETF. So it's going to be all the asset managers in the ETF space, or anyone who manages mutual funds. And that is a fund that is at new all-time highs. So
interesting.
That tells me the financial space is in good shape. That's helpful for the broader economy in a sense, right? We never like when the economy might be humming along, but financials are starting to deteriorate.
2008.
2008 being the prime example. And I do think healthcare is interesting. It has been a really challenging time for healthcare if it's not GLP-1 related. But it's been such bad performance, and there's been a lot of outflows from healthcare ETFs that I wonder if it's an environment where it's so bad it might be good if you're a contrarian for what that's worth.
Well, we met at a CMT event, that's Chartered Market Technicians, last week. And
oh boy, not the place for me. Not the place
right.
for me.
Well, here you can type away.
Yeah, I'll type notes.
All right. So we met at the CMT event, and we were talking about biotech. And what I've never traded individual biotech stocks, but I've traded the ETFs. I happen to like IBB. You can trade other ones, but my thinking there is I don't understand. I don't even have the ability to understand any biotech company and what they're doing, their trials. I can't necessarily understand the science, but an ETF allows me to participate and kind of mix up a few different companies. What's your thoughts on this?
Exactly. This is what ETFs are basically made for.
Okay.
And I'm agreeing with you. I can't trade biotech.
You should go to the CMT event.
No, now I'm in. Yeah.
Everyone should join. Take a look at the CMT Association. We're doing great things on the technical front. But biotech stocks can be lottery tickets. Whether they get a drug approval or not, that can make or break the stock. And so an ETF allows you to diversify. And the most important thing is to know how is it weighted, right? So IBB could be is cap weighted, so the biggest stocks will have the most weight, or something like XBI is equally weighted, so the biggest stocks and the smallest stocks are all in the same playing field.
Can we just pause there a second and kind of highlight the difference there, because it means different things. When you're saying is the difference between market cap weighted, and that's when the biggest stocks get the most, and we know this like from the S&P 500, we got these 5 or 7 stocks. So market cap weighted means the big guys get the most juice, they get the most weight, whereas equal just means everybody gets one share, one vote, and those are two different strategies for the market.
Right, exactly. And when you equalate something, you're giving more power, in a sense, to the smaller folks out there, which there's nothing wrong with that. It's just a matter of, okay, well, what's working? If small caps are struggling, you may not want to equate, but I still like it for the diversification purposes.
Let me ask you something, because if we're only investing in ETFs, as a beginner investor, what's the one thing you should know or look at before you invest in an ETF? And don't say anything about like a prospectus or anything.
Read the prospectus.
Most people aren't doing that.
Only a few of us will read the prospectus to understand what's going on. Know what is in the ETF.
Yes.
Right? So if we go to the grocery store, most of the time, you probably look at the nutrition label, how much sugar's in it, how much carbohydrates, what are the actual ingredients. This is the same exact thing with an ETF. If you are scared of maybe biotech stocks, avoid an ETF that invests only in biotech stocks. So it's all about looking in the fund, knowing what the stocks are in it, where is it focused on? Is it focused on technology? Is it focused on Europe for whatever classification it might be? It's all about the nutrition label.
I have a question though. If you're going to invest in a simple tech ETF, and it has Meta and it has Microsoft and it has Apple, why don't you just buy Apple? I get the diversification argument, but when it's these large cap companies, why don't you just buy them?
I am not opposed to the idea of saying, okay, I feel strongly about Apple products. I'm going to buy Apple, but just in case Apple goes through a challenging time, you can bounce it off with an ETF that has less Apple weight in it. Maybe it's an equal weight tech ETF. So you're going to get the benefits of, if Apple's losing market share, who's taking that market share then? It could be Microsoft or pick anyone out there. So that you kind of balance out that part of your portfolio with the other portion of the ETF as opposed to the single stock.
Fair.
All right, we want to talk about flows for a second here. We've been seeing a lot of flows into tech. We could argue that it's a crowded trade, but I just want to get your take. What are you noticing here?
So flows, are not a signal to me, right?
Okay.
We don't buy or sell off them, but I love them as a read on investor psychology. What are investors doing?
Sentiment.
Exactly, sentiment. Where are they putting their allocations? And flows have been all in on tech, rightfully so, because that's been the correct place to be. But I am worried about maybe a little bit of too aggressive positioning and a summer speed bump of sorts, where that everyone is so all in on tech, the reverse happens, right? Kind of the crowd isn't leaning in too much of one direction. And then all non-tech sectors, if you were to dial it back about a year ago, are actually negative since then. So if I'm looking for areas that investors haven't been too interested in, it's anything but tech, right? That's where that financials and healthcare, industrials come in. So there is risk that everyone loves tech a little bit too much. Is it enough to derail the bull case? I don't think so. But of course, just keep that in mind as the summer and the election come into view. There's a lot of events out there.
Yes, there is. And hold that thought. We need to take a short break, but coming up, we're going to be talking big tech earnings and a look abroad for the latest Who Wore It Better. We are back in this episode brought to you by the number 73. That's the percent of S&P 500 companies that are beating on earnings this quarter. And this is according to B of A, just with the tally here. And by the way, we're pretty early into the season. But for those that have beat, it is with a 5% beat. And that, also, I should say 20% of earnings are in. So basically 80% left. And then, as I said, the 73%, that is the beat. How many are beating on EPS? It's a little bit above the average. I'll just lay it out for us. So what do you look at when you come to earnings season? Because you're not necessarily worried about individual companies here. You're trading ETFs.
Right. So from my perspective, it's all about the sectors in aggregate. And are they beating expectations? Wall Street's all about expectations. Is it better or is it worse? That's all it comes down to. The numbers themselves can probably confuse most of us. So I'm all about expectations. The expectations for tech companies are really high, right? The Mag 7, the top 10 weights. So how does the market react to their earnings? And then can the rest of the index, the bench of the S&P 500, all 490 other companies, can they continue to improve their earnings after a challenging few years? If they can meet and exceed those expectations, we'll be in pretty good shape.
I have a question about when to sell ETFs. You know, how do you make that decision? We're seeing the rotation right now out of big tech and into small caps. Does that mean you should just straight up start selling all of your tech ETFs? I'm being a little dramatic there. How do you kind of make that determination and pegging it to earnings? If you see Apple hasn't done well, I'm making this up, obviously, for 50 quarters in a row, and okay, sell Apple.
Yeah.
How do you make that decision when it comes to earnings when it's an ETF and it's kind of a basket of stocks?
It all comes down to your time frame, I think, in a way. If you are investing for the next 30 to 40 years, you want to stick with these things. These speed bumps will happen. Correct. The S&P average is about a 14% correction a year. That's a great opportunity to continue to add exposure and build your wealth over time. If you're someone who's playing more tactically, quarter to quarter, and these things matter to you, you could say, okay, I've had a great run in tech. I'm a little bit overweight, a little too much exposure for my liking. Let me sell a quarter or half of that position. That can get a little more tricky, right? There's tax consequences there too. So I think it all comes down to your time frame, and then also setting a plan. I may have been long tech for a year. I could say, if tech declines by 10%, I'm going to sell. That's probably a little bit too simple, but there's so many different mechanics you can use out there. If it crosses below a moving average, or could be time-based, right? I could sell it at the end of the quarter just because I need to rebalance out and need to put more money into other positions that are not technology. So it depends on time frame, and I think your risk tolerance too, and the person involved.
I want to circle back. You asked a really interesting question just a few minutes ago. You were asking, why ETFs instead of an individual stock? And just as we've been talking about this, a few other reasons kind of ticked off in my head. Individual stocks can be expensive. I mean, Berkshire Hathaway A shares are something like $300,000, so you might not have the money. But then you can also gain tax advantages, and we haven't talked about that in particular. I was just wondering, how closely do you look at the tax advantages of different ETFs when you're looking to buy or sell them? Because there can be different tax advantages depending on the corporate structure.
Yeah, so the majority of passive ETFs, right? Passive meaning they track an index, which usually has very low turnover, so you're not buying and selling all different constituents within there. And so the vast majority, I want to say 99%, of index-based ETFs don't pay out capital gains because the ETFs are able to defer those taxes using what's called the create and redeem mechanism. It's the secret sauce. If you are going to play with something that is more active, or in a case international based, that has different consequences in terms of taxes, but more often than not, you're not getting a tax bill until you click sell on your brokerage account to get rid of the ETF. And this makes ETFs a great long-term investment vehicle because there's no tax bill at the end of the year for you. Rarely.
I want to also draw a distinction between exchange-traded funds and exchange-traded notes. And arguably, ETFs fall under ETNs, and we'll put some definitions up on the screen so we don't get too turned around. But exchange-traded notes can trade a little bit differently. And I think an example that comes to mind is the Grayscale Bitcoin Investment Trust, which kind of became dislocated from the price. They didn't have the ability to be an ETF. They had to sue the SEC to eventually gain that. But when they didn't, there was a big price dislocation. Just wondering if you pay attention to those kinds of things.
So we look at ETNs. An ETN is technically a debt security. It's issued by a bank in a way. And those are, in a way, becoming more endangered. There's just less demand for them. They're not great for investors. They don't have the tax efficiency out there. And if the issuer, it comes with a lot of counterparty risk. If I'm the bank and I say, you know what, this fund has got too big, I'm just going to close it. That can happen. You can't really close an ETF unless there's low AUM and the issuer decides, okay, we've had no more.
And it's structured as a debt security.
Exactly.
So it just ties back to that.
So the consequences are much different for an exchange-traded fund versus an exchange-traded note.
You said they're becoming less popular, correct? So is there room for for exchange-traded notes in most people's portfolios? Should that be something you consider, or?
I would avoid them personally, honestly, because they just come with very different risks. There's counterparty risk, and the number of products is shrinking. I think they're going away in due time. Of course, there'll always be one-off cases where someone wants it for whatever reason. Like there's a 4x leveraged S&P exchange-traded note. That's not for everybody.
It raises, when we're investing, we got to think of the worst case scenario. So one of the things I think about is the flash crash, when we saw a lot of problems with everything, individual securities, ETFs, ETNs. But as I understand, the counterparty aspect of ETNs just makes them a little bit more dangerous in a high volatility scenario. What else? What else should ETF investors think about when they're worried about the worst case scenario?
Well, ETFs can act as shock absorbers in volatile environments, especially because they are so liquid. They have intraday liquidity. And so if I'm an investor and I have a position in a single stock and I'm worried about it declining or whatever risk is out there, I can then go buy an ETF of its peers in order to diversify especially during volatile environments. Or if I'm in stocks and I want to go to a treasury bill ETF, if the market is declining in a panic-like scenario, I can do that in a click. So ETFs act great in volatile environments. They're not exacerbating any sort of market structures. They're helping smooth things out.
Let me ask you, the classic like 60-40, like stocks to bonds, do you have an opinion on how much of your equity portfolio should be ETFs versus other stocks?
Interesting.
Me personally, as someone who loves ETFs, I'd say all of it.
Oh, 100%, 100%.
Of course. So, I think, I don't know if it was Bogle who was like this, but I've always read that there are some investors out there who have this small allocation in their portfolio for, I don't want to call it gambling, but that stock or two.
Fun money.
Fun money.
There you go. Stimmy money.
Stock that they're obsessed with, exactly. So yeah. I love the idea of ETFs because they're diversified and they have great tax efficiency for the long run. But if there's a company out there that you're saying, yeah, I just love this company, okay, allocate a very small percentage of it in your portfolio just to scratch the itch. And if it benefits you in the long run, great. And if not, you didn't lose the whole boat there.
All right. I'm all about FOMO prevention here. All right, we spend a lot of time talking about U.S. equities, but today we're going to be looking abroad to the land of the rising sun, that would be Japan, home of the Nikkei stock index, which has risen 18% this year, besting the S&P 500 in the U.S., which is up still a respectable 16%. So Japan has a small edge on the year so far, but what we want your expert opinion is where the opportunity lies in the second half of the year. And a quick reminder that it was only a few months ago that the Nikkei hit its first record high in 35 years, eclipsing its December 1989 bubble peak. And yes, Japan was in a bubble back then. So let's bring this full circle here. Who's wearing the prospects for the second half of the year better? Is it Japan's Nikkei or the U.S.'s S&P 500?
I would love if I could say equal weight S&P 500. I do feel strongly.
You know, we can. Let me just cross this out here. All right, S&P 500 equal weight. Which one do you like better?
I like the equal weight S&P 500. I think Japan's had great momentum. I like the story there. It's also a very different constituency, right? The ingredients are different. There's a lot more automobiles and consumer companies. There's a lot less tech than the S&P. I think my preference is still the equal weight S&P 500, but I do like Japan as part of a global diversified portfolio. And I'll add to your comment about the new high. One of my favorite pop culture facts is that the Nikkei is at a new high. This year, Michael Keaton's playing Beetlejuice in a new movie.
Oh, I like where this is going.
He played Batman in the Flash movie last year. And the last time the Nikkei was at a new high was when Batman and Beetlejuice came out, the original ones in 1989.
Wow.
So it's my random pop culture.
I love that.
Is there a correlation? Probably not, but it just really speaks to me as someone who's a fan of that stuff.
Yeah, interesting.
I have a question. How for this investor who's not very experienced, how much do you think they should allocate towards global, international equities, ETFs, kind of anything?
I think, and it depends on your risk tolerance. If you have $100 and 60 of it goes to stocks, right? 60-40 portfolio, 40% to bonds. Of that 60%, I don't think it can hurt to allocate 10 to 20% internationally. So Japan, Europe, if you wanted to put emerging markets in there, you can. That's a little bit different of an animal. But having Japan and Europe as this kind of counter tech heavy weight to the US, I do believe makes a lot of sense, as much as they have lagged the US historically.
All right, we're going to pivot, but it's not too hard to pivot because I want to ask you about Disney. Now, you've been to all the parks around the world, including one in the land of the rising sun. We'll let you talk about that. Which one is your favorite?
So Tokyo Disney. I'm sticking with it. I visited there 8 years ago, and It's an amazing resort. It's actually only a subway ride away from downtown Tokyo.
I imagine everything is a subway ride away from everything in Tokyo.
Their transportation there is amazing.
Yeah.
And they have 2 parks. One is very similar to the parks here in the U.S., and then they have Disney Sea, which is completely different than anything else in the world.
Does your love of Disney extend to the stock?
That's a loaded question.
That's a loaded question.
Believe me, I would like that stock to be active. They are in a hard time right now. The media business, I think, between Disney and Comcast and whatnot, they're going through a different environment. Streaming has been difficult.
Yeah. When you go to a Disney park, though, do you think of how it's translating towards the financials of the company?
Or are you just enjoying yourself?
Or are you just, Mickey Mouse?
One question. I would say mostly enjoying, or trying to enjoy, depending on how hot it is in Florida. But I do try to pay attention. Okay, what are the business levels? How crowded is it? But that's only one part of their business. Television and advertising is a huge part for them too, as well as film studios.
We got 30 seconds. Any last minute word for investors?
I think ETFs are a great vehicle of choice. Always look at the ingredients and stick with it for the long run too.
All right. Excellent words to end on here. Thank you for joining us, and we're going to see you next time. In the meantime, keep your dial locked to Yahoo Finance.
And a big thanks to Todd Sohn, who is the ETF and technical strategist at Strategis Securities. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching, and you can stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up 3 p.m. Eastern. You don't want to miss it.